Positive signs elsewhere, so we see what holds sway there. ASOS is interesting. The clothing retailer, sales slightly below guidance. Some capital moves there as well from the management. Guy, what do we see at the overall level?
Okay, here we go. It's time for the opening trade. Let's see what numbers we get posted first thing this Thursday morning. It is the 5th. Let's see what we are looking at. We are anticipating a negative start to the day. We are basically counting you down to US payrolls. That appears to be what everybody is now waiting to see whether or not it confirms whether we're going to get 25 or whether we're going to get 50 out from the Fed. So we start in the red, the FTSE 100. We don't have the FTSE 100 today. We're back to the FTSE mid, but we'll show you what the FTSE 100 looks like in just a moment. The Stock 600 is down by 1/10%. The IBEX is down by 1/2%. CAC 40 is down by 1/2%. So broadly, you're getting the picture. We are down circa 0.5% Critty in terms of the index. What's going on below the surface?
Well, let's start with the FTSE 100, shall we? We are seeing red on the screen here, and a lot of this is coming from your typical outperformers. Again, it seems to be a fairly broad decline to the downside when you look at some of the bank stocks that are down. But Anna, you've been mentioning this a lot. Commodities taking a bit of a hit when it comes to the FTSE from a sector point of view. The Stock 600 we're still waiting to shake out because remember we are waiting for some of those German companies as well to trade. Volkswagen, Volvo Cars, those some of the names that you had your eye on as well. The outperformer, however, seems to be utilities, which is interesting. I'm curious how much of that is a defensive trade.
Yes, could be defensive. In terms of the commodities markets, yes, we've seen iron ore and other metals weak again, and we've had days and days of weakness coming through, certainly in the copper price, iron ore not having a good experience, and that tying in with the weakness we've seen in oil. Oil is a little firmer this morning, but all of that, of course, does move things around in London just a little bit. We do have some movement then in some of the companies that we mentioned, a slightly smaller one, but of interest. Perhaps ASOS is up by nearly 10% this morning. A lot of complicated things being announced there, but there's refinancing in the mix, which perhaps is having an impact on where the share price is moving, even if they're talking about some of their sales guidance being a little bit light this morning.
ABF, I'm just waiting to see what is going to happen there. Actually, I didn't see a price on ABF this morning. This is the Western family-owned business. We often think about it as being a kind of food business of sugar, but it's actually, this is Primark, and it does seem as if Primark sales fairly flat at this point in time, and that appears to be taken as something of a negative. There is this trade-down story that people obviously are watching fairly carefully, but the British consumer actually, in some ways, holding up reasonably well at the moment, which if you look across the piece, actually is a bit of a surprise comparing it with other countries. But nevertheless, we'll wait and see what those numbers look like, but ABF was expected to be down sort of 3–4% this morning.
Yeah, well, speaking of some of the other movers, in the UK, you are seeing to the upside, you are seeing Reckitt is one of your biggest movers to the upside, I should say, and seeing some heavy volume. To the downside, though, you're seeing France underperform. Hermes seems to be taking a hit, down about 1% here. LVMH is also under pressure as we're seeing some of this pricing shakeout, also down about 1% as well. I'm curious how much of this is a little bit of a luxury bleed through, given I believe seeing some weakness in Tiffany in China as well. I'm curious how much of this is going to hit the rest of the sector.
So they've announced that they're going to halve the size of the store, basically, which is a pretty strong signal that they're not anticipating big demand going forward from here, and that story is becoming more and more negative. Is it being compensated elsewhere? The US feels like it's rolling over as well. This is an area that has been of such strength for Europe, and Burberry's going to be kicked out of the index as well. It looks like
yes,
from FTSE 100.
We're going to get that full story with our colleague Deirdre Hitwell coming up a little bit later on this hour. To your point about luxury, the CAC 40 then down by 0.5% this morning, and we see a lot of the luxury goods sit there. Let's talk about where we are on these markets as we head firmly into September. Now we're joined now by Zoe Gillespie, Investment Management Divisional Director at RBC Brewin Dolphin. Zoe, nice to have you with us. I mean, today's picture on markets looks a little, well, risk-averse perhaps, and maybe some rates plays in the mix there. We see real estate and utilities as the best performers, chemicals and basic resources, those, you know, very subject to the ebb and flow of global growth. Those are selling off this morning. How do you approach September? How much risk appetite do you have?
Thank you. I think we saw that obviously August played out, start of August, non-farm payrolls sent the market into a kind of tailspin, and we saw volatility kick through. And by the end of the month, I think we had a bit more clarity. The job numbers seemed to steady the market. And I think given that we feel as if it's a bit of a repeat that's happening again in September. So we've got obviously the non-farm payrolls on Friday. But there's certainly, I think, a bit of nervousness coming in, whether the consumer starting to weaken, whether we do see a slowdown in the jobs market, and then obviously the all-important rate cuts coming through, and whether it's actually going to be the soft landing narrative or we're going to see something worse. So from our perspective, you know, we're still bullish on equities, and I think we're just going to have to let this play out and see where the shake-up takes us, really.
So if you're bullish on equities, do you think that equities can do well even as the Fed cuts? Some people like to describe it as an equity market that can rally as long as the Fed isn't cutting for sort of panicked, really bad growth reasons, and unemployment isn't much higher, whereas equities might struggle if the Fed is cutting with some panic in mind.
Exactly, and I think if we see a kind of, as you see, an aggressive rate cut because of recession, then obviously it's going to put the equity market potentially at risk. But I think if you look at the earnings season we've just had, I think it's been positive. We've had more, certainly, companies with beats. I think the actual markets look fairly resilient. We don't see any weakness in earnings that would give us the real fear that recession is coming. So I think looking at the fundamentals of companies, we're still quite positive on the outlook. Volatility is a normal, natural thing, and you're always going to have, I think, this with, we've had a period of consolidation with rates, and now we're looking at the rate cycle. And I think markets are pricing in that rate cuts, and I think that's really what we're kind of coming down to, is what's going to be the first cut, and whether the Fed's going to go for the 25, go for the safe option, or whether the 50 is going to be the first cut. And I think we're still probably in the camp that we're going to see a 25 basis point cut just now coming through.
Are bonds going to do better than equities?
I think near-term bonds have done a bit better, and I think in a volatile time you've seen that. And I think that's from our perspective for building out clients' portfolios, where we have actually been certainly more supportive of bonds. But longer term, I think you've got to look at it and say, well, I think we're certainly more in favour of equities, and we still think the equity play is why we've got an overweight equities and why we're still a bit more neutral in bonds.
Okay, so do you near term, do you think the highs are in for equities? You sound like you think that actually there are gains to be had from here in the equity market. Where does the momentum for that come from?
Well, I think the momentum still comes. I mean, we still think the AI story will play out, and I think there's a lot of the weakness that we saw in any sell-offs we've had in the last couple of weeks. They've seen buyers come back in, and the likes of Nvidia. We had a bit of a sell-off in August, and certainly we got some buyers in, and we still think that narrative's going to play out. It might be that we have less upside from the next couple of months, but I think longer term we still see that as a play that we like. Looking at other sectors, healthcare had a really good reporting season, so you see kind of momentum in that sector as well. And I think certainly from our perspective, we're looking at equities and just thinking that fundamentally there's good companies out there, and we're still quite happy and keen to pick up good quality names. Whether the rotation starts to kick through after we see rate cuts in other sectors that haven't potentially been as strong, the likes of the small and mid-cap and other areas, which actually might benefit from rate cuts in other sectors which are more cyclical, and we might see this rotation actually broaden out a bit, and we think that's going to be supportive for equities.
So you mentioned two key sectors there, tech and healthcare, and they both seem to be, at least in this region, facing the exact same issues, which is valuations and whether or not, to your point, some of that success is done and will continue to play out. I'm curious, though, what names you're targeting, if you can, speaking within each sector. If we have this NVIDIA narrative that, to your point, still has some room to run, what stocks does that show up in?
Well, I think we're seeing the semi space, not just NVIDIA, but there's still sort of, we like that as a trade, so not just one. But I think that was just an example of one where there was a bit of a sell-off when we've seen that. We've obviously got AMD and other sectors, so there's a lot more depth in that sector, so it's not just one stock, and we think that could broaden out. So we've got that as a trade. And within healthcare, I think you look at some of the equipment makers, you've seen the likes of Alcon, Stryker, some of these companies have had a really strong year. And I think there's more to play there, and we saw that in reporting. They were the best sectors in terms of, healthcare was the best sector in terms of the reporting in Q2. And I think that was a lot of the strength there. And obviously you've had the weight loss type, the GLP-1s coming through, and the Novo and Eli Lilly. So there's strength in some of these sectors. And I think you're right, valuations are maybe a bit stretched just now, but I think we've got to kind of look at it and sort of look at the longer term picture. And we still think these are areas which we're keen on.
Let me just jump into the conversation with a bit of breaking news coming through on AstraZeneca. This red headline just hitting the Bloomberg terminal. China detaining AstraZeneca staff in a data drug import probe. So this is police in China detaining 5 current and former employees of the British drug maker AstraZeneca for questioning about potential illegal activities. This is interesting for a number of reasons. This is a business that has expressed a lot of confidence in China, has exposure in China, significant exposure in China. Also interests me, and we haven't got comment, we've approached AstraZeneca, of course, for comment here, but they have not decided to comment at this point. It will be interesting to see how they respond here, because back in 2022, they fell foul of Chinese authorities, and then they disciplined staff, and it seemed as if they sort of took that one on the chin. We'll see whether this has a different political tilt to it, or how the business responds on this front.
If you take a step back, it just flags again, though, the China risk. More companies have exposure to, how many companies have exposure to China that we're not fully recognizing here? How much of that is priced in? Astra is deeply embedded into the Chinese market and has made a big play in making investors aware of that. But is that something that increasingly is going to attract a discount? You're obviously seeing it within the tech sector. You look at what's happening with ASML. Is this going to be something maybe that we need to factor into our thinking as well from a drug sector point of view?
You make a crucial point. About 13% of AstraZeneca's revenue is exposed to China, and they're looking, to your point, to grow it. And I think this is fascinating. In the conversations we've had in previous iterations and interviews here, is that when it comes to the China risk in terms of, say, the U.S. election cycle, we know in the U.S. there has been push against the pharma sector to kind of pick one or the other. Is one we see in the tech sector as well. AstraZeneca has said, well, actually, we're still going to be moving ahead with our plans in China. So we'll see how this all shakes out. But Zoe, I want to bring you back into the conversation, because that China risk, we've seen it show up in the European markets, most through luxury. Your take on the luxury sector, is it China? Is it the risk in France right now? Is it the U.S. consumer? What is the Achilles heel of that sector right now?
Yeah, I think when you looked at it, I think it was certainly a good kind of China play, and we thought when the Chinese consumer came back in, and I think certainly the start of last year, luxury was doing well. The recent results certainly showed that there was weakness in the Chinese market, and I think now you're starting potentially to see a stretch in the US consumer, and that is a huge market for them. So we have seen weakness in the sector. I think we've seen the likes of Burberry today dropping out the FTSE 100. And I think there's also a bit of a shake-up between what's actual premium luxury and what really is now luxury, and what's potentially going to be traded down from luxury, and whether consumers are being more picky about what they buy. So I think the top end, the very high luxury, maybe isn't going to be impacted if the consumer's there. But I think certainly China, and if the US does start to sort of feel it, then it's a sort of an area you could see weakness. And I think that's going to other sort of sectors. We've seen it with beverages too, with the likes of Diageo, with certainly some of the consumers struggling there. So I think there's potential weakness coming through now, not just China.
Should investors see being kicked out of the FTSE 100 as a bad thing? Because it's really interesting. So companies generally, you see it coming, you know you want to trade lower. There is an index kind of effect that generally gets priced in before you get removed. It's interesting, Rob Arna's been talking about this. The FT's been picking up on it, talking about the idea that actually companies that are removed from major indexes, and you see this over in the States as well, but here in Europe, Hiscox is coming back in. It's had a really great run. Is there a sort of, do I see this as a kind of a bottoming out process for companies like Burberry? Do I see this as an opportunity, not necessarily as a threat in terms of the share price performance?
Well, I think a few things. I mean, obviously, from a kind of perspective of, I think, a brand, certainly, if you look at some of the European names, Wood France, I think if they were to see something like LVMH, I think from an iconic basis, Burberry's a British brand. So I think it's quite, coming out of the main index is an issue. Whether or not we see it as potentially a takeover target, I don't know whether somebody might come in and look at it as that. But, you've obviously got a lot of the exchanges, if an ETF might be selling down, so there can sometimes be a bit of weakness just because of the fact it has come out of the FTSE 100. But it's fundamentally, as a business, whether it is still going to have the recovery and whether they're going to have to reshape their business. They've had a few CEOs, they've tried to have a different direction, but at the moment, it's whether they go back to what they were doing at best and look at outerwear and their more iconic raincoats and things to try and recover it.
Well, the weather's certainly turning.
Yeah.
So, nice to see Zoe Gillespie, Investment Management Divisional Director at RBC Bruin Dolphin. I think Rob Arnott's going to be on the show next week, so we can talk more about this. Anyway, let's talk about the Cool Six, see what's happening right now. This is the picture we find ourselves with the major stocks across Europe. As you can see, an awful lot of red. LVMH, Ferrari, ASML, Schneider, Nestle, all lower this morning. It's interesting that Novo is the one stock story that actually stands out on the upside, talking of healthcare. Let's get some more single stocks that we need to be paying attention to. Lizzie Burden has all the details.
Risk-off day, so let's start with the losers this morning, and they include the European miners. So we've picked up BHP, Rio Tinto, Anglo-American, all in the red, because we've got iron ore prices keeping tumbling, actually to their lowest level since 2022. China's main steel industry group advising mills to be cautious about boosting output too quickly in case they snuff out this post-summer recovery. But they have been some of the worst performers on the FTSE 100 over the past month, and that continues this morning. Just flipping over to another pretty negative story today, AB Foods. You were talking about the weather. Let me bring you another very British story here. It comes back to Primark sales declining in the fourth quarter, they expect, because of the weather hitting footfall. So one of the biggest fallers on the stock 600 this morning, the biggest drop in more than a year. But then let's come to the winners, shall we? Vistry shares, I mentioned these earlier, earnings out this morning, and they are up today, one of the biggest gainers on the stock 600. The home builder saying that completions are up, in contrast to Barratt Development's completions drop yesterday. Traders also appearing to like this £130 million share buyback announced this morning because of higher revenues and pre-tax profit in the first half, and the new government's house building plans benefiting Vistry as well because of their focus on affordable housing. And then more positive news, staying on the fashion theme, ASOS shares up 12% now this morning, earnings out at the top end of estimates. They're selling a load of Topshop and Topman, but also they make reference to AI. Returns, obviously a bit of an issue for e-commerce brands, but artificial intelligence helping them, along with personalisation and improved imagery, to keep that returns rate at bay. They're your movers this morning.
Thanks very much, Lizzie. Lizzie Burden with an update for you. Coming up on the programme, tumbling sales and profits, and now it's been relegated from the FTSE 100. We've mentioned this a couple of times this morning. We'll get that deep dive, that focus on Burberry's troubles. That's coming next. This is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
bigger challenge next.
It was going to keep rain World Cup. This is a 3
As the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
We've seen softening in the demand, even though the beauty market in the UK remains very dynamic at around plus 10%. So it's a very resilient market, but it's been softening lately, especially as we see people arbitrating with also the rent increase, the mortgages.
This year started with an expectation that the luxury markets will grow between 2 to 4%. My personal feeling, it will be much less than that. Probably it will be flat. The reality is that Europe, US is still very flat at the moment, and China is still weak.
If I look at China, we do see some slowdown in the luxury side of things. I mean, in the premium sector.
China is a very essential market for the luxury ecosystem because of the fast adoption of luxury, because of the retail spaces being so beautiful and so luxurious, because of the appreciation of refinement and sophistication. So it's a very important and essential market for us. We're a long-term company, so we continue to believe in China, continue to invest in China.
These are some of our guests talking about what is happening with the luxury space broadly, globally, but with a China focus. And the China story continues around this space. It's fascinating. Tiffany in 2019, 1,200-foot big store in Shanghai. It's decided it's going to basically give back circa half of that, an indication of what is happening in this space right now, particularly in China, but more broadly. But China feels like it's the epicenter of the action. Just weakness after weakness, the consumer retrenching. It started in China. China never saw the luxury bounce back that we saw in the rest of the world post-COVID. And that it's been amazing to see just the fact that that has persisted. Everybody's been waiting. It never came. And then the downslope came.
Yeah, the store expansion is an interesting one that they're pulling back. By Anna, by comparison, Tiffany also just opened a similar kind of facility in New York. I'm curious how much of that is a bet on the U.S. consumer.
Let's talk about where these luxury names go. Another company that's been feeling the bite of the slowdown is Burberry. The British brand has now been relegated from the FTSE 100 after its market cap fell by a third over the past 3 months. Let's get more with Bloomberg's Deirdre Hipwell, who joins us here on set this morning. Good morning to you, Deirdre. So what on earth has been happening at Burberry? This feels like a long story.
Yes, nothing good, really. If you look at the past year, we've had 3 profit warnings. The CEO has gone, the dividend's been suspended, and the latest indignity is being demoted from the FTSE 100, which of course is where they've been for the last 15 years. So they are facing a very difficult situation, as is their new CEO, Joshua Schulman.
Well, speaking of that new CEO, one of his criticisms is he's trying to appeal to a mass market when he is indeed leading a luxury company. How's he doing?
Well, I think what he's going to have to decide is, does Burberry want to
keep persisting with the strategy of elevation, as they call it, trying to enter the elite super luxury ranks, you know, become the LVMH of Britain, shall we say. But that's something they've been trying to do for the past decade, and they've gone through 4 CEOs and 3 creative designers. So you know, he's going to have to consider, is that a strategy they still want to pursue?
Yeah.
Or is he going to row it back a bit?
Is Burberry a luxury company, or is it a company that sells coats?
I think it's probably what you'd call an elevated luxury company at this moment. They certainly have done very well in outerwear. That's something that always performs well for them. I think what's gone wrong in the last 2 years is they put in too much of what you might call the fashion overlay, the fashion forward type of designs, and then they pushed pricing up too high. So they turned off their core customer, and then they didn't have enough new customers to compensate for that. So I think there's definitely a rebalancing. It was already underway under the previous CEO, Jonathan Ackroyd, but of course it wasn't moving quickly enough,
Yep.
so they've brought in a new broom.
Yeah, I mean, coats make sense. We get a lot of rain, so, you know, it would seem to fit the profile. But this isn't, those things are specific to Burberry. You set that out clearly, Deirdre, but the slowdown in luxury, as we were just discussing around Tiffany and other names, isn't unique to Burberry. So where else are you watching?
Absolutely not. It has been very tough in luxury, and I think it's not necessarily going to improve anytime soon. I think everyone is struggling, but that's when it comes down to, and certainly investors will be looking at the company execution and strategy. And what we've seen is the companies that are doing better, the likes of Hermes, are the super luxury whose customer base is very wealthy and can still afford to buy the luxury items that they want. But for the others, it's going to be a lot tougher, and I think they're going to have to figure out how they're going to chart their way through these murky waters.
Deirdre, we're going to leave it there. Thank you very much indeed. We assume that the being kicked out of the FTSE 100 is a bad thing. So it's really, so the FT's picked up on this recently. Rob Arnott's been talking about it as well. He's launched an ETF fund that basically is designed, this is over in the States, designed to pick up on the companies that have been kicked out of indexes, because apparently they outperform over the medium term. And it's interesting, so we've got Rob on the show on Monday, which I'm really looking forward to get his take on all of this, Monday, Tuesday next week. The Lex columnist scanned the numbers on this. Discretionary index deletions outperformed the index by 15% on average 6 months after leaving. British Land and Hiscox, which are going to be coming back in again, are the real kind of poster child of this kind of trade. But it's interesting, we kind of assume that this is the bad day. This is the bad day. Burberry gets ejected, but actually, in some ways, you front-run this trade. So the market will know this is going to be coming, and therefore front-run it. So the shares is going to be pushed down as a result of that. But once you get kicked out, actually, that's the good thing. It's a bit like the fallen angels thing within the credit space.
Yes, and this is clearly a big enough thing. It's got its own ETF, a deletions ETF.
Yeah.
So we'll certainly get that ready for the conversation next week. But Kriti, you know, and some of that reporting that you're referencing there, Guy, making the point that, of course, because for all of those that are promoted, you'll get one NVIDIA and maybe a whole host of other frothy names that'll be back down as quickly as they rose.
You know, I'm really liking that we're nerding out on rebalancing, because in the next 24 hours, we're about to get one from over in the States with Apple and NVIDIA, which I think is a fascinating one. So one of the heavyweights potentially in the UK index now, potentially rebalancing some of the heavyweights in the US index as well. That's going to be a question that we're going to continue to explore in the next 24 hours. How does that shake out? How much of it is really Warren Buffett's fault in terms of how he is investing in two of the biggest names in really the world, not just the S&P 500? Coming up, we're going to dive into that macro conversation. Will the macro beta continue to see that trend gain? Ian Harnett from Absolute Strategy Research thinks that it absolutely will. We're going to speak to him next. Stick with us. This is Bloomberg. In the meantime, a quick check on these markets here. You are seeing a little bit of a rebound off the lows, but we're going to see how long that continues. There's a lot of moving factors, a lot of a political overhang. That conversation next. This is Bloomberg.
top names in business are on Bloomberg.
The challenge for us now is not very much on the product. It's on the ramp-up of the production system.
We turned the industry down to almost zero during the pandemic. And what we're trying to do now is turn it all the way back on. And that's hard. We lost not only people during the pandemic, we lost a tremendous amount of experience.
A lot of skilled people have left the industry. We have to hire new people. The supply chain has to hire new resources and train the people, educate them.
And because those roles are filled now not by a 58-year-old, but perhaps by a 28-year-old, there's a lot we have to do in terms of not only adding capacity, but capability to meet the ramp that we all are embarked upon.
We have thousands of suppliers, and when you have just a couple of them, few of them that are late on the ramp-up, well, that's slowing down everybody, and that's what we've been facing earlier this year.
Nobody covers business like Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
This is the opening trader at 30 minutes into today's session. We were expecting a bigger pullback, and instead we're actually seeing the market open lower but bounce back off the lows, pairing some of those losses. We're going to see how that actually shakes out as we go into the rest of the trading day. In the meantime, we are getting some headlines coming out of German Finance Minister Christian Lindner speaking about the auto sector in a banking conference at the moment. He's basically saying he opposes exploring state aid for the auto sector. The context of this is crucial, given that Volkswagen is talking about closing down their key plant there and really pulling back on some of their EV strategy as well. They say their strategy of auto firms is up to their management. Those comments, again, coming from Christian Lindner. On the other side of that equation, Volkswagen is also talking about a union strike potentially coming in October. One of the labor negotiations are around the workday, a 4-day work week, Guy, being considered.
Absolutely shocking to hear Christian Lindner talking about being a fiscal hawk.
Yes, he's showing his political colours there.
I'm stunned by this news.
But there's a little divergence in his thinking versus other members of the coalition,
yes,
which is interesting. But he's somebody we listen to on this front. So yeah, he's opposing exploring state aid for the auto sector. They'll be listening.
I'm sure they will. Let's talk about what is happening in the markets right now. A little bit of weakness coming into September. I say a little bit of weakness. It's obviously been a fairly bumpy week. Are we seeing some stabilization today? We're a little on the downside, but we're really waiting for the payroll number. Where do we go from here? Let's try and answer that question. Ian Harnett, co-founder and chief investment strategist at Absolute Strategy Research, sitting around the table with us this morning. Nice to see you.
Good to see you too, Guy.
You're reasonably positive short-term on equities. Why?
So, I think that you can look at the environment that we've got now, and it's going to potentially be a very unusual one. We've moved from a multiples-driven market to an earnings-driven market, and those earnings expectations are still very strong, particularly in the United States. And it's really unusual to see a world where the Fed cuts at the same time as earnings are positive. You've basically got a double whammy there that's going to keep you pretty well supported. So until one of those two changes, until we have a very different narrative coming out of the Fed, or until we see those earnings numbers start to really tank down, then I think it's pretty difficult to be too bearish. Tactically, you can see the odd sell-off, as we've seen in August, and we're seeing now. But I think it's just very difficult. And we've been constructive on this market all year.
Would big Fed cuts scare you then?
historically, the larger the Fed cuts, the bigger the risks that you've had. But remember that of the 14 pivots that you've had since 1917, 12 of those were actually very bad for equities, and they were forced by really high unemployment or some kind of financial crisis.
So a 50 basis point cut would make you nervous from the Fed?
50 basis points, I think, would be surprising. It seems to me as though there's what I would call a Basel consensus towards 25 basis points, and I think that you'll see that probably from the US, potentially from the ECB next week, and then, from the Bank of England as well.
Does it seem to you, Ian, that there is anything in the jobs report or potentially in CPI that could prompt them to do 50? Because there's a lot, we always go to this sort of conversation about the possibility of 50, and I'm not sure, and expectation has built since the jolts and the beige book yesterday, but not by much.
Yeah, not by much. Clearly those jolts numbers were pretty weak. Remember that one of the things we need to focus on there is the government side. The bulk of that employment growth that we've seen since the start of 2023, 2024 has actually been in education, health, and government employment. So actually those government jolts numbers coming down was really, for me, the things that was the interesting thing there. Ironically, if you look at what the claims numbers have done in the last 6 months, they would actually be suggesting that the unemployment numbers might come down for the next couple of months. And this is another reason for thinking that perhaps that 50 basis point cut is a bit too optimistic. Bearing in mind that the market itself is looking for a cut, a reduction in unemployment from 4.3 to 4.2 tomorrow.
Yeah, so if you're fairly optimistic about equities, do you have to take a view that the market is not going to get spooked again like it was in August by BOJ hiking? Because we've been reading quite a bit this morning from colleagues talking about the market underpricing the risk of a hike at a time when we're waiting for US data. Makes people feel nervous, perhaps.
Well, remember that the comment was not now about that Japanese rate hike. You're certainly seeing, we certainly see that you feel that you're seeing some increasing wage pressures, some stabilization there. Just think about how long we've waited to lose that deflationary bias in Japan. That normalization, think of it more of a normalization, that is going to change how things work. But, so I don't think we should get spooked by that, and I don't think we'll necessarily be spooked by those, CPI numbers next week. Looks as though that exported deflationary pressure coming out of China is really making a lot of central bankers look like heroes, and that they'll take advantage of that. But again, that'll be another reason why I think they'll err on the side of caution rather than erring on the side of being a more drastic move, because those services numbers aren't really moving as rapidly, aren't really coming down particularly rapidly.
So I think what's confusing for a lot of investors and economists and even retail traders around the world is you're talking about the slowdown, and you see it in the economic data. The beige book was very doom and gloomy, as we discussed. But then you look at the earnings picture, and yes, there's a slowdown there, but the margins are still growing, and the consumers are still able to digest it. How does the Fed respond?
And I think, critically, that's the absolute essence of it. So we call this an uneasy equilibrium. It's very unstable. You've got this balance between those earnings numbers and the economic surprises, which for the last 3 months have been really very weak in the United States, particularly on a nominal basis. So, the ability of the corporate sector to eke out these margin gains, particularly for large cap companies. We've seen some pressure on smaller cap margins as, the supply chains have been put under pressure. It's how that plays out over the next 6 months that will be critical here.
So let me argue my exact opposite point, if I can. This is the perks of being a journalist. The flip side of that argument is that you're already seeing layoffs in a lot of the sector that is increasing the margins. And the only reason the margins are able to increase is because American consumers specifically, you're not seeing other parts of the world, are able to digest it. But there are signs that that's ending, and you see that in auto loan delinquencies, you're seeing that in the savings rate. Is there a time frame, you said the next 6 months, where we can see that become more pronounced?
Well, I think the key to this, and I think you've highlighted exactly where the issue is, which is that we've seen non-bank financials provide credit to both corporates and to households this sector. So to the degree that we start to see those non-banks pulling back, and you see some of these buy now, pay later, type companies having more stress in their delinquencies. And we saw that, the delinquencies, particularly for small lenders, increased very sharply recently. The stress will actually come on those financials, the smaller financials, rather than the consumer first, would be our guess. For now, that wealth effect for the consumer, plus the fact that inflation's coming down, allowing real incomes to rise, provides a pretty healthy support.
So you brought us lots of charts this morning. So I see your charts, and I raise you this chart, which is NVIDIA versus the S&P.
Yeah.
NVIDIA has front-run the S&P over the last year. You can see it really quite clearly. NVIDIA goes down, market goes down. NVIDIA goes up, market goes up. NVIDIA has detached on the downside from the S&P. Should that be something that I pay attention to? How important is NVIDIA in your world right now?
So I think one of the things that we've flagged over the last year is that NVIDIA has lost, I think, 50% of its market cap, I think 13 times in the last 20 years, Guy. It is a highly cyclical stock. All this talk about it, so let's not lose sight of that. Those cyclicals now have actually sold off very aggressively. We're actually looking for a bounce back in cyclicality over the next 3 to 6 months. And from that point of view, probably we may have seen the worst of this. But remember that the earnings are spreading out, and that's one of the things that our strategy team has been highlighting. The earnings.
So I can pay less attention to NVIDIA because NVIDIA earnings have become super important for this market.
Well, they were super important for about a day and a half. And then what did we focus? Then what did we focus on? We focused on the PCE numbers on Friday. Yeah. So we still see this as a macro-driven market, and in our work, we find 80% of total returns are actually being driven by macro factors, not micro alpha.
But this is something, this trend that Guy's talking about, this kind of division between NVIDIA and the S&P 500, is something we've seen in Apple in previous iterations. And we paid attention to Apple because it was a consumer story. And I'm curious, I know you say that we only pay attention to it for a day and a half, but isn't this a financial conditions reflection mechanism on the Fed? Doesn't that factor in?
So, the closest link that you have there is, say, the link between NVIDIA and Bitcoin. And that being a link to overall liquidity conditions in the market. Looking at the correlation of those two assets and the expanded financial liquidity environment from the Fed plus TGA and reverse repos, those have worked quite nicely. So if anything, that's telling you, that pullback is already telling you that we've seen some tightening in liquidity short term.
Are you connecting the Fed to Bitcoin?
Oh, absolutely. Have you not seen that chart? Oh,
I've seen it, but I guess
it's a liquidity proxy. Yeah, and these things are liquidity proxy, particularly where they're very highly retail driven. Then you're seeing those kind of liquidity trends play out. Now, clearly, there's been some, market factors and fundamental factors on that, the disappointment. And one of the things that we've emphasized on NVIDIA is that the capex spend of the buyers of NVIDIA's products don't add up to the sales that NVIDIA are talking about. So we've been raising that with clients. So there's some disconnect there. There is hype, but that hype is about liquidity. And so that's why I would link those things.
Yeah, that takes us to the comments we got from some of the analysts on Monday that really sank the share price of NVIDIA around, when are we going to see this showing up in other companies outside some of these big tech names? But I want to go away from tech because obviously NVIDIA has been important to the US. Cars, for as long as anyone can remember, have been important to Germany. Yeah. So bringing it back to Europe, we were talking about Christian Lindner, the finance minister in Germany. He's been saying that he does not want to explore, he opposes exploring state aid for the auto sector. The strategy of auto firms is up to their management. What is the investment case? Is there any investment case you can come up with for German autos at this point?
Well, I think the valuation case is the best case, and the degree to which we're looking, let's link a few of these ideas, Anna, which is that actually remember the other thing that's been important for Europe has been its ability to export to China. So, that weakness of China, the continued overproduction that our team are focused on in terms of that Chinese export-driven model coming back into play, and the manufacturing-driven model, that's the thing that's actually holding things back at the current time. We see, still a major weakness in China. So for now, I think it'll be difficult to see those German exporters, really come back. But, at the same time, what we need is a bit more dollar strength, euro weakness to help them out.
Okay, and we were seeing the PBOC talking about the possibility space for triple R cuts. You never know if they'll use that tool or some other tool to try and do something.
At some stage, they need to break out of this, the problems that they have in the housing market.
Okay, thanks so much, Ian. Really good to see you. Thanks for joining us. Ian Harnett, co-founder and chief investment strategist at Absolute Strategy Research. Coming up on the program, we turn our attention to the energy sector. OPEC Plus is considering delaying a planned boost to oil in oil production. We discuss the factors prompting a rethink among members. Next, we've certainly seen a big retreat in the oil price this week. We'll get to that shortly. This is Bloomberg.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Welcome back to the opening trade. About 46 minutes into today's session, seeing a little bit of a turnaround story when it comes to these equity markets. We opened in the red across the indexes and bounced off the lows. We are now in positive territory, but not a major rally there. Let's see how that shakes out as we go into the rest of the trading day, and certainly into the U.S. as well. In the meantime, we want to get a quick check on what's going on in the commodity space. So given all the volatility we've seen in oil prices this week, OPEC Plus delegates have told Bloomberg that they're close to an agreement on delaying a planned increase in oil production. It comes after Brent crude, as I mentioned, slumping this week to its lowest level in 14 months, erasing all of its gains throughout the week. Let's bring in Anthony DiPaolo, Bloomberg's Middle East energy markets reporter, to walk us through what's actually going on in the space. Anthony, walk us through the ups and downs of this week. Why is it so turbulent right now?
Yeah, good morning. Well, we've had a lot of movement. First of all, the underpinning thing in the market these days is that concern over demand, that there's not going to be enough demand to support prices and to soak up all the oil that's coming in the market. On top of that, you put in the OPEC Plus issue, which is that OPEC Plus was set to bring back some of those barrels that they'd taken off the market starting from October. That was a group of countries in the OPEC Plus producers group that had made voluntary cuts, and they wanted to start unwinding those and getting those barrels back on the market. That comes at a time when the market just doesn't seem to be ready to take those extra barrels. So what we're understanding is that the OPEC Plus ministers are taking that into consideration and are looking to delay this increase in oil production, so push that back potentially through October, potentially later in the year. We're waiting to hear what those countries say, potentially some announcements today or in the coming days about what they might do going forward about that increase in October.
Okay, so that's what we might hear from OPEC then, Anthony. I mean, what do you make of the fact that we got these lines yesterday? Our reporting made this clear yesterday. Did it put a floor under oil? I mean, we do see oil prices bouncing a little this morning. Didn't send them back from where they've come from, though, back up to where they've come from. What did you make of the market's response to this kind of line? It seemed to perhaps underscore the concerns around growth, the China and the US economic concerns.
Yeah, well, we had a lot of reports from analysts from Goldman, from Citi, talking about prices even, pressuring 70. So Brent going below 70. We already did see WTI drop below 70 this week, but even Brent and Citi talking about even more trading pressure that could drive it close to 60. So with that increase, we were probably headed for much lower prices because that would lead into a surplus towards the tail end of this year. Potentially, we're looking at a surplus even into next year as well, too. So that's kind of that pressure on the oil price that's keeping it really from bouncing back, as you said, to where we were before. It's that concern over demand. Weakness in China. We saw some weakish data on the manufacturing PMI from the U.S. earlier, so that tends to reawaken some of those recession concerns in the United States. So it's really that concern about demand weakness that keeps a lid on those prices.
And people are paying attention to the connection with what is happening with iron ore at the moment and the weakness we're seeing there, and whether or not that is a leading indicator for maybe the broader oil market as well. Anthony, great stuff. Thank you very much indeed for the updates. Anthony DePaolo joining us out of Dubai. Let's talk about the setup as we head towards the big number of the week. That, of course, is the payroll number. We're going to get some ADP data today. We're going to get some claims data, but we're really waiting for the non-farm payroll number, which will drop tomorrow. Michael Masika, Bloomberg senior reporter covering equity markets and strategy, joins us now. Feels nervous. Everybody's a bit on edge going into this number. Volatility remains high. VIX is at 20. Give us a sense of kind of how we're set up. What are you hearing?
Guy, the first thing I would say is there is a sense of caution from pretty much everyone, but there is no sense of either panic or think that this bull market has come to an end right now. People are reducing exposure. You have like hedge funds selling a bit of tech, reducing their exposure to like crowded trades. So we see kind of a lot of that. But overall, it's just caution rather than pessimism, I'd say.
What does the positioning look like going specifically into tomorrow? It looks like the options market is doing something.
It's doing something. We've seen a lot of reduction in risk in CTAs. They've been starting like selling, but not from asset managers. Asset managers are max long, especially on the S&P 500. I think as long as they've ever been, and this has moved a bit in August, but came back right up to max long. So it's kind of there's a mix of, you have fast money exiting the market, but coming back very quickly as well. Yeah. So buying dips, selling tops, and you've got long only managers and asset managers, like longer time investors that are still very, very long the market and very long tech.
Yes, long the market, long tech. And so for those people, are they not worried when they see NVIDIA down by 9% in one session on not much? Because we got a couple of analysts who pointed out things that people really kind of knew, and the poster child for AI collapsed in a day. I mean, you talk about people are not panicked, it's just a little bit of caution. I suppose it depends how long tech you are.
Yes, definitely. But I mean, the thing is, a lot of people are like, if you compare the weight of tech into the benchmark and how risk managers and asset managers have to construct their portfolio, they can't be as long tech as the benchmark is. So technically, let's say it's a bit less of a problem. It's still a problem. If you look at the S&P and NVIDIA, it's been literally driving the market the whole year. So
I stole this chart from you, by the way. We've been putting it up all morning.
But I think as some funds start to reduce their exposure to that specific stock, and that's what's been happening lately, there'll be less of an impact on the broader market.
Volatility has a memory.
Yeah.
Talk us through that and the impact of the VIX at 20 and how risk is changing if volatility stays high.
So what happened is, like, when you have like a big spike in volatility like we had in August, it's usually followed by, other spikes. Not necessarily as high, not necessarily higher, but you get some sense of market stress for a period of time, and that's what we're seeing here. So this is impacted by market makers and how people are positioned in options, like mostly. And you see those are technical spikes, but they have an impact on the market. And then you see market falling a little bit more. Is this like a warning that things are going to collapse, or like we're going to have like a big bear market? Not necessarily. And most of the time it isn't. Now, having said that, we are in a month where you have a lot of things that are going against the market. So we've got the Fed meeting that everyone is waiting for. We've got the job data everyone is waiting for. Job data until now has been like going, pretty bad, I'd say. I mean, if you look at JOLTS yesterday, the openings will be like, lowest in a while now. So it starts to show that the economy is slowing down, really slowing down. It's still a soft landing at the minute, but all that is bringing caution into the markets. Outside of that, you have the Fed meeting in next 10 days or 2 weeks. And you also have the blackout period that's going to start. Buybacks have been a very, very strong support of the market, especially in August, and it helped the market coming back to high. The blackout period, like I think end of next week, 50% of S&P companies will be in this blackout period. So that's another support of the market that's going to vanish. So you have a September month, which is really tricky. And it's part of the reason why September is always like a tricky seasonality. It's a bad month for equity markets generally.
You mentioned that key buybacks piece. I think I read somewhere that the August buybacks from S&P 500 companies was up 19% or something like that on relative to its average. It's massive, but you talked a little bit about the VIX and the options positioning there as well. What are the signs from a normal market panic, a lot going on as you outlined, to something like a 2018 fall repeat of a Volmageddon 2.0? At what point do we get to that level of panic?
I think we are still very far from it. I mean, even when you look at the spike that we had in August, it was so technical and so quickly. It came back so quickly. I think the market has, adjustments. It adjusts very much quicker than it used to, and this is what we're seeing also right now. So you got that vol spikes. You got a market that is really shaky. The problem is, like, everyone is really focused on growth at the minute, and what's going to happen with the U.S. growth and with the U.S. job market, and what the Fed will do. And we're kind of in a tough spot where if it's too hot, that's not good. If it's too cold is not good. It needs to be like in line.
Sounds like a story someone once told. Michael, thank you very much. Bloomberg's Michael Masika with the latest on the markets. Fantastic to have you on set with us this morning. Lots coming up today. We've got a gilt auction, US data in focus around the jobs market, as always, as it is Thursday. We also have the former president and wannabe president again, Trump, speaking later on about his economic agenda. So we'll certainly focus in on that. That's it for this hour of programming. Have a good day, everybody. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching the close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Or other authorities.
Could face bigger challenges next.
It was going to keep
Green World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg. Treasuries get a jolt from soft U.S. jobs data, further supporting the case for a supersized Fed cut, while European stocks waver. Japanese real wages rise for a second consecutive month, keeping the BOJ on track for another potential rate hike later this year. Plus, Kamala Harris breaks with Joe Biden on tax rates. The U.S. Democratic nominee says those earning $1 million or more should pay 28% on capital gains. Now, we have a lot going on. It feels like we're still Monday, but we're actually Thursday. So let's take a look at the European markets map. We've been all over the place, but a little bit more calm, certainly, than it was on Monday and Tuesday here in Europe. But you can see the FTSE practically unchanged, I guess gaining 0.1%. The DAX and the FTSE MIB gaining 0.3%. Now, a lot of the focus, of course, on the JOLTS jobs number in the U.S. I have to say, in general, not only in Asia, but also what we're seeing with S&P futures. A lot of these markets are now stabilizing after days of declines over uncertainties about what the Fed does next and over the health of the U.S. economy. Now, traders, of course, looking at the weekly jobs data, the claims data due out later today. And then the other thing we need to watch out for is yen currently at 143.63, because that's really moved some of the Japanese equities. So for the conversations that matter and the insights you need, let's get started.
market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. It's been a big markets week, so joining us now, Mohit Mittal, Chief Investment Officer of Core Strategies at PIMCO. Mohit, as always, thank you so much for joining us, especially on a week where there's so much expectations fluctuating about what the Fed does next and how many cuts we'll get. Do you believe markets are getting ahead of themselves?
I think there is a lot of data that is still coming. I think tomorrow or the Friday's jobs data would be very essential for the Fed. I think our view would be that likely scenario, Fed delivers a 25 basis points cut, but in a scenario where the jobs data continue to show weakness, there's a good case to be made for a 50 basis points cut. If I just take a step back and think in a little bit longer term horizon, I think what you observe is an economy that is transitioning from what we would call a post-pandemic sugar rush to a pre-pandemic trend growth. And that pre-pandemic trend growth is give or take 1.5% real growth plus 2-point-something% inflation. And in that backdrop, 5.5% Fed funds rate is quite restrictive. So it makes sense for the Fed to cut rate at a moderate pace. The challenge would be at too aggressive a pace of rate cuts could shift the balance on risks of inflation towards the upside. So moderate pace of rate cuts is prudent. So
basically, your base case is that inflation is doing okay, and so the central bank, the Fed, can now go to its second mandate, which is growth. What's the probability of not getting a soft landing?
Yeah, so I think a likely scenario, as I mentioned, is like this shift from a post-pandemic sugar rush to a pre-pandemic trend growth, which is closer to 1.5% real and 2-point-something% inflation. There's certainly a scenario wherein growth is below that. I think we would assign a little bit of a lower probability to that based upon current data. When you look at the current data from a consumer point of view, from corporate earnings, from bank earnings, it's pointing towards that scenario. But of course, we have to be open-minded about the uncertainty around data, particularly after recognizing that the Fed funds rate have been in the restrictive territory for about a year and a half now.
So how many cuts are you expecting from the Fed? And I know we also heard from Howard Marks saying, look, then they're going to be stuck around 3 to 4%. Is that right? I
think the neutral rate closer to 3% on Fed funds is reasonable. I think pre-COVID, the neutral rate was much lower. I think certainly it has moved up a little bit, but it has not gotten to a level that it was pre-financial crisis. Right. Pre-financial crisis, you recall, the neutral rate was closer to 4%. So we would be in that camp of a neutral rate on Fed funds in the next couple of years being closer to 3%.
So where do you see actually Treasury yields ending up? And so where do you see opportunities in the market?
Yeah, so again, I think if I take a step back, what you observe is a fixed income market that looks quite attractive. Yeah. When I was on your show in April, we talked about kind of value having been re-emerged in the fixed income markets. Recall, in the Q1 of this year, early Q2, 10-year had sold off to about 4.7%. Certainly, you've seen some repricing, but even if we look at valuations today, they look very attractive for the long term. You have starting yields closer to 5.5% on high-quality fixed income, and then you say that in many states of the world, you can realize that. And then the other important thing that has happened is the inverse correlation of equities versus stocks. Right. So from that point of view, fixed income makes a lot of sense in an asset allocation sense, because in periods, for example, what you saw in first week of August, when you had -5, -6% equity returns, fixed income did quite well. So there's value in fixed income from a diversification versus equities, and then also a yield enhancement versus cash. So certainly, I think on a longer-term basis, fixed income looks quite attractive here.
But overall, I mean, the PIMCO favors buying bonds outside of the U.S. Is that fair? And is that because of the differential with other countries?
I think we do find good opportunities outside of the U.S. I think UK looks quite interesting from our point of view. When you look at 10-year UK gilts, give or take, 4%, 30-year 4.4, 4.5%. UK, from our point of view, is an economy that probably has a trend growth of near 1% in the next 1 to 2 years. Inflation is moving towards 2%, and then the fiscal picture is different in UK relative to that of the US. In the US, we are running closer to 5 to 6%, maybe 6 to 7% deficits. In UK, we are closer to 2 to 3% deficits. Right. So given kind of lower fiscal, impulse in the UK relative to the US, lower growth trajectory, and then valuations where they are, UK certainly looks interesting. When we go beyond UK, like Australia would be another market that looks interesting.
Well, I mean, if you look at rates volatility in the US, they've definitely been overshooting other regions. Do you expect that to continue?
I think with respect to rates volatility, I think the U.S., the thing is that U.S. Treasury market is a very high-quality duration asset. So in any kind of risk-off environment, U.S. Treasuries would do much better than many other countries, even UK and Australia included. Yeah. So you can kind of see that that is happening in the last couple of months as well. So that volatility is elevated because it is acting as that risk-off hedge. But then the other side of it also is that growth, while slowing down, is not kind of going into a recessionary territory. So if you have a data, like for example, if next week or later this week or next week, you see some recovery in data, you could see some movement in the US rates as well.
And just going back to the UK, I mean, you laid out basically the investment, business case for the UK. We hear a lot of negativity from Labour about how much they have to do in the budget, about how worried they are that they don't have enough money, blaming it firmly on the previous government. Is there a worry that actually the gilt market gets shocked on October 30th when the budget comes out?
I mean, I think there is certainly a possibility, but I think there has been a clear kind of lessons learned, and you can see kind of acceptance of the lessons learned. So, certainly possible that kind of event gets repeated, what you saw in September 2022, but I would assign a lower probability to that. I would still think that the deficit picture in UK would be in the 2.5–3% range, and that makes a reasonable case for having UK gilts in the portfolio.
The Bank of England could probably be less dovish, I guess, than other central banks because the economy is stronger, right, overall. What are you expecting for quantitative tightening? I mean, this is huge, that program, and actually a lot of people don't often talk about it.
Yeah, so I think even if I kind of think about, Bank of England in a little bit of a broader sense, what you see is, like in the likely scenario, this month, you could see a Fed cut rates 25 to 50 basis points. You could see ECB do another cut, but there's a chance that Bank of England does not deliver a rate cut this year. They continue, but by December, they start to deliver another rate cut. So if I take a kind of a 1-year horizon or 1.5-year horizon, I could see Bank of England move rates from, give or take 5% currently to about 3.5% in the next 12 to 18 months.
France, oh la la. They're not. Do you worry? I know that they have high debt costs. Yeah. They're going to probably stay. We don't know what happens in the budget, and they still don't have a prime minister.
Yeah. So I think, look, France. You saw, when Macron first announced the election a couple of months ago, you saw meaningful weakness in French government bonds. Oats at that time widened to almost 85 to 90 basis points over bonds. And that was a good opportunity to add exposures. Since then, what we have seen is Oats recover towards almost 70 basis points over bonds. That to us looks a little bit fairish, given kind of the uncertainties, as you pointed out as well, with respect to Prime Minister. So from an investor point of view, in the French government bond market, we would say it looks fairish. But if there is volatility, we recognize, it's going to be temporary. So if you see a reversal back towards 90 or 100 basis points over bonds, it's certainly going to be an opportunity to add exposures again.
Well, in Mohit's world, I mean, when the markets go crazy, but bonds behave in the way they should be, is there a sign of relief? Do you actually look at it and say, like, oh, finally, we're back?
Well, I think we've always maintained that thesis. There's a very, strong value in having bonds in the portfolio. Yeah. I think what happened in 2022, like when you saw meaningful kind of move rate higher in rates, people started to question the correlation properties. And I think what that misses was the idea that correlation has always been a function of inflation. When inflation is high, then fixed income is no longer going to be as attractive a hedge. But now there's a pretty substantial evidence that inflation is firmly in the 2-point-something territory. Like with what we are seeing in the commodity markets, that should further support inflation moving in the 2-point-something territory. The weakness in the growth data again supports inflation in the 2-point-something category. And in that environment, when you can lock in 5.5% to 6% yields in high-quality fixed income for 6 to 8 years, it's a really good value.
Mohit, thank you so much, as always, for joining us. That was Mohit Mittal, Chief Investment Officer of Core Strategies at PIMCO. Now, I also want you to bring you a Bloomberg scoop. Now, police in China are said to have detained 5 current and former employees of the British drug maker AstraZeneca. Now, that story came out about 20 minutes ago. They're being questioned about potential illegal activities to do with the company's collection of patient data. Now, sources say the individuals being held are all Chinese citizens who marketed cancer drugs in AstraZeneca's oncology division. So we'll, of course, keep a very close eye on this developing story. Coming up, OPEC Plus considers delaying a planned boost in oil production. We discuss the factors prompting a rethink amongst members next, and this is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Well, time for a commodities check. Iron ore slumping to its lowest level since 2022 amid concerns over China's recovery. Meanwhile, OPEC Plus is close to agreement on delaying a planned boost in oil production after prices plunged on fragile demand. Now, in a moment, we'll be speaking to Seema Shah from Principal Asset Management. But first, joining us is Will Kennedy, Bloomberg Senior Executive Editor for Energy and Commodities. So thank you, Seema. I'm looking forward to our conversation on crazy markets. Commodities a little bit less crazy, Will.
This morning, but it's been an eventful week, and the common theme between iron ore and I think oil and to some extent copper as well is that while there are particular things going on in each of those markets, people are very concerned about the strength of the Chinese economy, and I think they've got back from summer and they're seeing a lot of weakness, and that's really putting pressure across all of the commodities sector.
I mean, oil, today I'm looking at the chart is actually pausing, near this 14-month low. But are there real concerns that oil could be the first indicator of almost like a global slowdown?
Yes, China, I think, is very much in focus, but we've got lots of things going on on the supply side as well. The market's also been focused on the prospect for more OPEC oil into the market. And, of course, there's a lot of focus on discussions that we've been reporting over the last couple of days that OPEC may, in fact, decide to pause on that output increase. And we're waiting today for details of how long they pause and how much oil that they hold back. And that will be key to tracking how the market develops over the next couple of weeks.
I mean, we're also tracking this Libya production as there's this tussle between rival Eastern and Western government threatened supply. Is it surprising that geopolitics haven't really impacted the oil price that much?
Well, I think Libya is important because Libya, in contrast to the crisis in the wider Middle East, has actually taken barrels off the market. We've seen probably 500,000 barrels that were coming into the market off the market. I think this week, one of the reasons we went lower is that the central bank governor who Bloomberg interviewed indicated that a solution to the political issues in Libya might be closer at hand than people thought, and that renewed downward pressure. If those barrels did come back quickly, it would add to the bearish mood in the market.
Will, thank you so much. Will Kennedy there, who oversees all of our commodities and oil coverage. Now, joining us now is Seema Shah, Chief Global Strategist at Principal Asset Management. Seema, thank you for coming on to put all of this into context. We have a lot of stories that then you wake up on Monday and you see the markets literally fall out of bed and you kind of wonder, what is this, like an economic ugliness about to take over, or is it just market jitters and valuations?
I think there are real questions about the strength of the U.S. economy. You look across a number of indicators, all pointing at an economic slowdown. And I think the question that the market is grappling with at the moment, and of course affected by seasonals because everyone expects September to be a terrible month, is they're looking at and say, does slowdown necessarily mean recession? And can the Fed come in and really provide that kind of defensive nature that the U.S. economy probably does need at this stage?
But see, we haven't really seen a correction. We have these, big sell-offs, and then they go back up markets to where they were. So are they too optimistic about the way forward for the U.S. economy?
I don't think they are, actually. I mean, we're definitely in this soft landing camp. I think like all other analysts out there, since the July jobs report came out, we've gone back through all the economic data, done all the analysis. And we're still of the mindset that, yes, slowing activity is currently the theme. You can see that across the labour market. You can see that across consumers as well. But there is nothing so intrinsically broken about the US economy compared to, say, 2007, that policy stimulus can't fix. So we do believe that, let's say that the Fed stepped back and let the economy just move along as it was expected to, then recession would likely be on the cards at some point. But we know that the Fed is willing to step in. So we actually are fairly confident that the US economy can do okay.
So you're also confident that inflation doesn't really pick up from here, because worst case scenario is, of course, higher inflation, slowing economy.
I think that's one of the risks, which is actually under priced, or at least underestimated. You don't really see people talking about the inflation numbers anymore. I mean, even when the PC number came out last week, no one really takes much notice. So I think at this stage, when we look at the components of inflation, we don't have too many concerns that it's going to come back. I do think, though, that once the Fed does start to cut rates, let's say move by 50 basis points, another one in November, it's not our central scenario. But if that does happen, and you see mortgage applications increase fairly significantly, we could potentially be back to that overheating moment early next year, in which case inflation does become a problem again.
So is it tricky for the Fed to navigate? Will they be worried about doing too much or too little?
I think at this stage, I think they're a little bit more worried about doing too little. Certainly that's the theme that you're getting from Chair Powell. But I do think they're going to be cautious. You know, when we look across, again, the historic data, it's rare for the Fed to cut rates the first time by 50 basis points. Typically, the labour market is much, much weaker than it is today. So I would say that they're going to move somewhat cautiously, but of course, so much depends on tomorrow's report.
Stephen, I know we were talking about China. I mean, it just feels like we have pretty discouraging or worrying news, but nothing really is priced in a meaningful way. I mean, away from the U.S. and Fed moves, is there anything else you worry about?
Well, I think the key thing is that global growth is a little bit lackluster. There's nothing particularly impressive out there. So one of the concerns is that, again, you look back at previous downturns, and there's always been one very strong side of the global economy that can come in and really lift growth and have those positive effects around the world. You're not really seeing that because China's kind of stepped out of the show. Europe is very disappointing, I'd say. I think there was a moment of hope earlier this year, and that really hasn't come through. And actually, ironically, it's the UK, which actually looks like the market, which has got a bit more, staying power. So I think there are serious concerns, not enough at this stage to trigger a massive pullback, because we know central bankers are going to come in size potentially, but enough to probably bring down expectations for what we can expect from returns from risk assets.
Seema, thank you so much. Seema Shah from Principal Asset Management stays with us, and we'll talk a little bit more about the UK and also Europe. Plenty more analysis, and this is Bloomberg.
Earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything. from our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
As the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome back, everyone. Now, still with me, Seema Shah, Chief Global Strategist at Principal Asset Management. Seema, we're having a great conversation about some of the, what you're watching out for in the Fed, and of course, the jobs data is the big one on Friday. Now, this morning, J.P. Morgan scrapped some of their bullish calls on China because of risks around the trade war. Are you changing any of your calls around that?
So we've been quite underweight China for a while. I know there was a moment probably early in about February where we did sit back and think, right, are we getting this wrong? Because there's so much bad news and pessimism priced in for China that could you get a slight upturn? And of course, the market did do well for a month or two, but it's run out of steam again. And I do think that the US election and everything around it is going to continue or to restart weighing on China. And there's not that much good news coming out from them. The policy stimulus isn't there. Probably not enough to offset the additional negativity which is likely to come from the US election.
You're right. I mean, we haven't really had that bazooka policy support that many market participants were expecting. But are we going to see more of a rhetoric against China as we get into the US election that actually translates into lower economic growth?
I think we will. So we know that the agenda against China is bipartisan, so you're going to hear it from both sides of the camp. And that's going to be a key narrative, which also has a lot of support across the voting public. So this negative sentiment of what could happen to China, what's going to happen to the various sectors, is likely to continue weighing on them. I think the one factor that we do step back and have a little bit of hesitation is that valuations are already very cheap. It's quite a struggle to find anyone out there who is positive about China. So if there are any kind of upside surprises, and let's say the government does come in and recognize that there is going to be some additional negative impact on China's economy from the rhetoric and from the potential tariffs, that then they get a bazooka moment. That's potential, but at this stage, and listening to the way that they talk, they're in here for the long term. It's very unlikely that you're going to see a very, very significant stimulus package that would offset what's coming from the tariff side.
Seema, thank you so much for joining us. Seema Shah, their Chief Global Strategist at Principal Asset Management. Coming up, we also turn our attention to emerging markets. Goldman Sachs telling us why the macro looks good, but the politics is risky. Overall, for example, oil actually setting near the lowest close since June 2023. Again, we had an industry report this morning pointing to a big draw in U.S. crude stockpiles, with the market taking a breather following a sharp sell-off this week. We'll have plenty more on markets next, and this is Bloomberg.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in London. These are your top stories. Treasuries get a jolt from soft U.S. jobs data, further supporting the case for a supersized Fed cut. Japanese real wages rise for a second consecutive month, keeping the BOJ on track for another potential rate hike later this year. Plus, Kamala Harris breaks with Joe Biden on tax rates. The U.S. Democratic nominee says those earning $1 million or more should pay 28% on capital gains. So, as we were just saying, U.S. presidential nominee Kamala Harris wants to raise capital gains tax on people earning $1 million or more. So, speaking at a campaign event in New Hampshire, the Democratic candidate said America's wealthiest should pay their fair share.
If you earn $1 million a year or more, the tax rate on your long-term capital gains will be 28% under my plan, because we know when the government encourages investment, it leads to broad-based economic growth and it creates jobs, which makes our economy stronger.
Well, we're now joined by our anchor, Kriti Gupta, who's been following, of course, the campaigning from very close. Kriti, thank you for joining us. When you look at what Kamala Harris is trying to do, I mean, she's basically saying, I'll look after a lot of people, especially, the less rich Americans. Does that put her in an awkward position in going against Donald Trump?
It has almost a advantageous position, some would argue, Francine, when it comes to kind of the pushback that she's getting in some of her other economic policies, including things like price gouging, addressing issues in grocery prices, in Medicare prices, in housing prices, even something that economists are looking at and saying, well, would this create stagnation in the U.S. economy? This seems to be her response to that, where she's talking about a 28% capital gains tax. To your point, really talking about the industry and really talking about how this could actually help businesses. By comparison, you're seeing the graphic on your screen right now. Joe Biden proposed as high of 45%, and of course, Donald Trump is still proposing tax cuts on this. So you are starting to see this become kind of a little bit of a concession here in really trying to get the business community on her side, all subject to the passage of this in Congress, of course.
So she's trying to basically convince voters to trust her on the economy. Is it working?
That is exactly the perfect way to put it. It's not working just yet, but what it is doing is showing that her policy could be different from Joe Biden's, and where he's really getting a lot of the criticism in his current term is that a lot of the gains are really coming more driven by the Federal Reserve rather than something he's done in terms of adding more jobs. The concern is Kamala Harris is going to be simply status quo, and to your point, she's pushing back on that she's going to be far more than that.
Kriti, I know, among some of her proposals, and again, there are more that will be coming, some of the proposed measures will include cutting some of the red tape for startups. What do we know about takeovers?
Well, we know that she's going to be tough on tech. That's something that's bipartisan on both sides. But we also know that she's commented on one particular deal that's really causing a lot of commotion over in the States, and that is the proposed deal from Nippon Steel to U.S. Steel. And this is important because U.S. Steel, even though is a major kind of a smaller company, not really even traded in the major indices, is actually a landmark company for the United States back in its heyday, back in 1916, when the U.S. manufacturing sector was rocking and rolling. But Francine, since then, it has been bleeding employees, bleeding growth, even bleeding steel production. The problem is that this is still one of the key companies for the U.S. manufacturing sector that both Kamala Harris and Donald Trump and obviously Joe Biden, you are seeing bipartisan support that this is a deal that cannot go through. U.S. Steel has said that if this deal is blocked, as the Washington Post has reported Joe Biden will try to do, they will have to close down some of their steel manufacturing. That is not going to play well into a lot of the employees, specifically in the Rust Belt and specifically in the demographic that both Donald Trump and Kamala Harris are trying to appeal to.
Kriti, thanks so much. Kriti Gupta there with the very latest on the U.S. election campaigning. Now, political risk and the potential for higher tariffs if Donald Trump returns to the White House is, of course, casting a long shadow over emerging markets. That's the view of Goldman Sachs, who says the macro outlook for EM is good, but warns that developing economies have more to lose in a global trade war. Let's discuss all of this with Kevin Daly, co-head of economics for Central and Eastern Europe, Middle East, and Africa at Goldman Sachs. Kevin, as always, thank you so much for joining us.
Love to see you, Francine.
This is a great report. It's comprehensive. It goes through emerging markets. You see some upside for emerging markets, but again, they're caught, I guess, between dollar and whatever dollar does, and the fortunes of China, which is linked to the U.S. election.
So, I mean, let's start on the macro first. I mean, the macro outlook for EMs has actually been pretty impressive. I mean, growth at the moment is currently tracking around 4% annualized on our metrics. I mean, that's, you know, much higher than we have for DM growth, which is around, 1% or even less annualized. We're talking about recession risk and a lot of DMs. On inflation has fallen faster than it has done in DM economies from the peaks early last year. The gap between inflation in EM and DM economies is now close to a record all-time low. External balances since the pandemic in EM economies have improved pretty significantly. And if you're to identify countries where external balances look fragile, it's more often going to be DM economies rather than EM. So the problem, with EMs this year and for the last 18 months has not been the macro. The macro performance has been very good.
So what is the problem going forward? I guess in certain cases it could be political stability, but also if China really does worse, they're going to be affected, right?
A lot of it this year has been the external risk. So we saw that in the first half of the year when you had the hawkish repricing of Fed policy that put a lot of EM assets under stress. And now as we're heading into the second half of the year, of course, the prospect with, there's all eyes are on the US elections, the uncertainties around that. The tariff proposals by former President Trump, would, in all likelihood, if they are implemented, trigger retaliatory actions. In a global trade war, it is important to emphasize that everyone is a loser, including the US in that scenario. But the economies that would lose more than most are export-orientated economies, and emerging markets tend to be, their growth model relies on export growth. So for countries like China, but also across EM more generally, that is a major risk that we need to monitor.
But Kevin, if you look at some of the emerging markets, how closely tied are they with China? So China, again, it could suffer really from trade and tariffs. We've also seen some pretty tepid policy from authorities in China to deal with this downward trend of the economy.
Yeah, so China, China is there is clearly some weakness there. We think some of that, we think in Q3 will be relatively weak. We think actually there will be a recovery in growth in Q4. On the policy front, there's been significant issuance, which implies that actually there is some fiscal firepower there potentially for more stimulus on the fiscal side going forward. Our forecast for China growth this year is around 4.9%. So it's it is weak. It's weaker than it has been in the past. It's not a disaster though. I think some of the performance, some of the pessimism around China is sometimes overstated. But more than that, actually, you're seeing outside of China. You see, if you look at other Asia EM economies are continue to grow very strongly. India in particular, but not just India. You see across a lot of emerging markets in this time zone are performing relatively well. Even LATAM. I mean, LATAM over the last year has been the weakest performing area of emerging markets, but some of those economies are showing signs of improvement as well. So it's not just a story about China.
So, Kevin, what are some of your recommended trades and conviction views? So let's start with equities, maybe.
Yeah. Well, I mean, EM equity valuations are very heavily discounted. So from a longer term perspective, we are very positive on EM equities. From a shorter term trigger, I mean, in an environment where if you have Fed easing in a non-recessionary Fed easing, which is our central case, we think recessionary risk in the US is exaggerated.
So moderated easing, I guess.
So moderate, yeah. I think the bar to a 50 basis point cut is actually relatively low. But if there's a sense that they're fall behind the curve, I think there could be more risk presented by that. But if you have non-recessionary easing from the Fed, that is a sweet spot for EM assets. I think equities would do well in that environment. We also think that fixed income in particular would do well in that environment. We like Mexico, we like Poland, we like Korea, fixed income, and I think EM currencies as well. So, we are relatively constructive on most EM assets going forward, but fixed income in particular.
When you look at currencies, what happens to dollar actually in your scenario? Because that will move things around.
Yeah, so in a sort of moderate non-recessionary easing environment, we have moderate depreciation in the dollar. I mean, it's tricky in the sense that if you have a risk-off sell-off, I mean, the Fed needs to walk a pretty fine line on this and needs to gauge this very carefully. But if you have a severe risk-off environment, then EM assets will tend to do badly in that environment. And counterintuitively, even though it would be bad for the U.S. economy, the dollar would probably do well in such an environment. But in the moderate non-recessionary Fed easing that we expect the dollar to weaken somewhat and EM currencies to do well against it.
So, but that could change on Friday with the jobs report.
Yeah. I mean, in the jobs report, we're as I say, we're actually a little bit. Our US team is a little bit below consensus on NFP. We think the bar to 50 basis point move is relatively low, but our central case remains 25 at least for now. So, yeah, it is definitely all to play for tomorrow.
Thank you so much, Kevin Daly there from Goldman Sachs with very latest on some of the emerging market plays. Now, coming up, military cooperation and $50 billion in financial support. China goes all in on strengthening ties with Africa. We'll get more on that story next. And this is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Well, China's President Xi Jinping has vowed to provide Africa with $50 billion in financial support over the next 3 years and strengthen military cooperation in a sweeping effort to deepen China's relations with the continent.
After hard work in the 1970s, China-Africa relations are now at their best period in history. I propose to elevate the bilateral relations between China and all African countries that have diplomatic relations with China to the level of strategic relations.
Let's get straight to Bloomberg's Ondiro Ganga, who's in Kigali for us. Ondiro, so what were the key highlights from President Xi's speech?
Thank you, Francine. So this was a highly anticipated speech, and you can tell by the number of African leaders that attended, there were greater expectations going into it. For a long time, this summit has been Christmas, and President Xi has been center, granting every wish that they bring on board. However, this time around, his checkbook was a little bit tight. Africa only got $50 billion over the next 3 years, and this means that $30 billion goes into credit line, another 10 to 11 billion goes into various assistance, and another 10 billion Chinese companies investing in the African continent. And this just signals the end of an era. Those days of mega infrastructure project with massive funding from China are over. Now it's a new phase, which President Xi Jinping terms as an era of small but beautiful projects. So now every coin that comes into the African continent from China will be well thought through, and it has to have greater benefits to China. Take an example, the Tazara railway line that they want to resuscitate going to the East Coast. First of all, it counters America's project, the Lobito corridor in the West Coast. And second, it allows them guaranteed access to critical minerals for their EV market back at home.
Ondiro, how are African governments then likely to reconcile this with the new reality of reduced funding from China?
Currently, they're not, and it's going to be a long road and a long walk for them, because take a look at President William Ruto. He was going to China with the hopes of securing funding to expand the SGR project, one of China's big projects in Africa that ended up being botched. And now we're seeing that China is walking back its financing. This is a continent that has a couple of problems. China has always been the alternative source of funding. And now in a season where they're struggling with raising revenues, budget deficits are high, and also they're in debt distress, it's going to get really tough before it gets easier. China has already laid out its plan for Africa. Now it's time for Africa to go back to the drawing board and lay a plan for Africa, unless it's going to get tougher before it gets easier, because money from the World Bank and IMF comes with conditionalities that have caused social and economic tension across Africa.
Ondiro, thank you so much. Ondiro Oganga there with the very latest, of course, on China and Africa. Now, we'll have more on China's relationship with Africa in this month's edition of Africa Amplified, and that comes out tomorrow, 5:30 a.m. London time. Coming up, tumbling sales and profits, and now it's been relegated from the FTSE 100. More on Burberry's troubles next. This is Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays. A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
I was also on record as saying that change would be a good thing from a government point of view. We all needed certainty and stability, so a two-term government would be a good thing, not a bad thing. I think from UK PLC, where financial services I think is genuinely important, we just need some stability around tax, whether that's personal or corporate, and we need a competitive lens on our regulatory framework. So yes, we've got to regulate well, but we've got to ensure that we're an attractive proposition for businesses for a number of different reasons. So we'll be vocal in saying that's not our job to set policy, but we will be vocal in making those points.
How does that affect, though, not just you, but the reinsurers you work with as well? If we're talking about this very strong kind of commercial underwriting trend, doesn't that kind of take a big chunk out of that?
We've got to be very careful. So 80% of our business is non-UK derived, so most of it is international.
But you're having the same risk in the US, no?
Correct. So if you look at the world at large, 70 of the countries in which we trade will have been through elections in the 12-month period that we're talking about, 60% of the world's population. Ironically, I know this sounds odd in the context of the question, we probably feel more stable here than we do in many other places. When you look into Europe, you look at the uncertainty in France, in Germany, what does that really mean for Europe? In the US as well, we've got the elections coming up, what does that mean? So oddly, we probably feel more comfortable in understanding the direction for the UK at the moment than almost anywhere else.
Well, that was John Neal, Chief Executive Officer of Lloyd's of London, speaking to us a little bit earlier on with Kriti Gupta. Now, to some other stories making news, and Bloomberg understands that the UK is to make further changes to water company insolvency laws as fears grow that debt-laden Thames Water will run out of money next year. Now, it's the first time that the new government has hinted that special administration, a form of temporary nationalisation, is an increasing possibility for Thames. Now, the company, which supplies water to 16 million people in and around London, is seen by the government as too big to fail. NVIDIA says it is in contact with the U.S. Justice Department, but has not been subpoenaed over an antitrust investigation. The DOJ often sends requests for information in the form of what's known as a civil investigative demand, which is commonly referred to as a subpoena. Well, Bloomberg understands that the Justice Department has sent such a request seeking information about NVIDIA's acquisition of Run AI and aspects of its chip business. The picture for NVIDIA pre-market, you can see gaining some 0.9%. Now, HPE shares fell in extended trading after the company reported weaker than expected margins. Its adjusted gross margins stood at just under 32% in the fiscal third quarter, marking a decline from a year ago. Now, this suggests that lower than anticipated profitability in its closely watched AI server business. On to other corporate stories, and UK luxury brand Burberry is to drop out of the FTSE 100 later this month, with insurer Hiscox taking its place. Now, Burberry is being relegated after its market cap fell by a third over the past 3 months as consumers continue to tighten their belts. Well, we're now joined by Angelina Rasquet, our European luxury retail reporter. Angelina, thank you so much for joining us. Burberry has had a tough time, partly because people are spending less, partly they probably don't have the right product mix that the wealthy want to buy.
Indeed, Francine, that's been the story of Burberry. I mean, basically, after the pandemic, we saw boom years in luxury. All the luxury brands were selling a lot as people were getting out of their houses. But in the past, in the recent months, we've seen that Burberry has really struggled. It's in turnaround mode. It was trying to elevate the brand, to make it more exclusive in the eyes of the consumer under the previous CEO, Jonathan Akeroyd. They also hiked prices, and that strategy hasn't really delivered. So in July, they got rid of him, and they named a new CEO.
So if you look at the new CEO, what are some of his big challenges?
Indeed, so his name is Joshua Schulman. He's American, and he was previously at Michael Kors, which is considered to be an affordable luxury brand. So obviously the question from investors is that will he sort of slow down this elevation strategy? Will he also try to bring Burberry into the affordable luxury category? So we'll find out more from him in November when he presents his vision for the brand for the 6-month earnings of Burberry. The question mark also for Joshua Schulman is that will he get along with Daniel Lee? Daniel Lee is the designer that's been at Burberry for the past 2 years. He was named under the previous CEO, and typically when a new fashion CEO is named, he or she, they like to appoint their own designer who will translate their commercial vision. So we'll have to see how that relationship goes on. And there's been a lot of pressure internally to deliver winning design, but obviously the context has been that maybe Burberry pushed too much into that fashion forward category, and so far it hasn't really been really welcomed by consumers. So these are some of the challenges. I mean, right now, and as you mentioned, it got kicked out of the FTSE 100. So maybe it's from here it's actually it could be positive because maybe they'll receive less scrutiny from the markets.
So is Burberry unique in its slowdown, or how many more are also struggling?
Generally, I mean, there's been a clear slowdown in demand for luxury goods, but obviously in the luxury space, you have different levels of exclusivity. Some brands, such as, if you think about Rolex, Patek Philippe, Hermès, they cater really to the uber wealthy individuals, or Loro Piana at LVMH, and Burberry was situated sort of in the middle. And also, if you're in a turnaround phase like Burberry, but also like Gucci at Kering, it makes it trickier when there's a sharp slowdown. So it's a different picture according to different brands.
Angelina, thank you so much. As always, Angelina Rasquet, their European luxury retail reporter. Up next, we'll have plenty more. Bloomberg Brief with Danny Berger and Manus Krani in New York. The picture firmly on that U.S. data, of course, that we'll look at tomorrow. Markets for the moment a lot more stable than they have been in recent days. Stocks definitely pausing ahead of that U.S. jobs data. Traders looking towards weekly jobless claims due out later today as well. And then the non-farm payrolls is a big one on Friday. We look at yen. We look at dollar treasuries. Little changed after tumbling yesterday on the data showing a slowdown in the U.S. labor market. The dollar holding steady. This is Bloomberg.
what about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Good morning from our global headquarters in New York. I'm Manus Cranny alongside Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bond traders raised their bets on a jumbo rate cut. 50 basis points could be in play. More data on deck today. A brief disinversion in the yield curve. Softer jobs data challenges the Goldilocks narrative. And to Washington, VP Harris unveils her capital gains tax plans as POTUS gears up to block a foreign takeover of U.S. steel. Good morning, Manus.
Danny, good morning. There was a powerful readjustment to risk yesterday, and it centered on the bond market, down by 10 basis points at the short end of the curve, as the JOLTS data came in softer than everybody expected, and that appraised the rates market. Down went the bond yields. Equities are struggling with their own issues in terms of what size of rate cut will we get. Tesla's up this morning. We'll talk more about that. Their self-driving package potentially coming through in China and in Europe. But it was this rates redux that really we've got to try and grapple with. Jobless claims today, along with the ADP. And that powerful re-rating on rates, Danny, drove the dollar higher and the yen lower. So again, this is about a narrative of where will the curve go to. A brief moment of disinversion yesterday. Good morning.
Driven by what? JOLTS data that we know the survey rate is low, that we know is backwards looking, that captures that July period that we already knew was weak. We're in this period where we're so sensitive to each point of data, and it is the Fed themselves that are underscoring this behavior from the markets. Mary Daly speaking to Reuters late yesterday, and she was asked, what are you going to do, 25 or 50? Her answer, we're still collecting data. We have a labor market report. We have a CPI report. We have all of our contact information. 2 weeks away from a decision, and they're still waiting for the data to tell them what to do.
If we take our mind back to Jackson Hole of when Powell said any cooling in the labor market would be unwelcome. So I think the focus as we go to Friday is going to be on the jobless, the percentage of unemployment, because that takes us back to the SAM rule. And I like what a couple of people are saying is, look, if you've actually got to cut rates, cut when you can, not when you need to. And that's a really important narrative.
Well, that's been the criticism of the Fed, right? That they have been able to cut and they haven't. But again, you keep hearing from Fed officials, and Mary Daly says this in her interview too, that their constituents, when they go out and talk to people, inflation is still a concern. So you can see them still wanting to hold back.
Yeah, the data probably says that's in the rearview mirror, that the street is yet to actually really catch up with that. We are waiting for more hints on the U.S. economy today. Here's what Oaktree's Howard Marks had to say on the Fed's rate path. The Fed will back off from the emergency rate of 5.25%, 5.5%, and get to the 3s. My belief is that we're going to stay there in the 3s, and we're not going back to 0 or anywhere near that. Joining us now is our cross-asset strategist, Ven Ram. Ven, good to see you this morning. I mean, Danny and I have just talked about this jolt in the Treasury market and the moment of disinversion. How will Treasuries fare out of this series of rate cuts? Some people are saying to me, you may even see a pop in rates on the first cut.
Absolutely. I think that, Treasuries are kind of overpricing how much the Fed is likely to do. I mean, based on current indications, as you said, there's plenty of data still to come. So the field is wide open for the Fed to go bigger. But assuming that the Fed goes only 25 basis points, there is room for correction in front-end Treasuries because they are already pricing in a lot. Now, I would like to go back to that quote that you cited of Mark. I think that I agree completely with him, and I think that we should be prepared for a 3-point-something rate from the Fed, because if you pass the Taylor rule rate, Manus, what it shows is that the Fed has room to cut rates by 215 basis points. And I think even if they don't go all the way to 215 basis points, they can cut by, say, 200 or 175 basis points from here, which would take you to about 3.5%. So I think that investors should be prepared for that kind of terminal rate.
And that's pretty much what's priced in over the next year, Ven. Ven, there's also been this really wonderful debate on the Markets Live blog about whether or not we should care about a yield curve disinverting. It did it for the second time intraday yesterday. How much should we care?
Well, I think we should pay heed to what is coming from the yield curve disinversion, because the yield curve is disinverting for a reason, and that is the increasing wobble in the labor market that we are seeing. There's no doubt that the labor market momentum is cooling and the economic cycle is aging, and increasingly the cracks are appearing to show. So I would err on the side of caution here rather than say that it doesn't matter at all.
Fair enough, Ven. Appreciate it. As always, that's Bloomberg's Ven Ram. Let's now bring in Henrietta Pacamon. She is the head of global fixed income at Allspring. Henrietta, you look at this bond market and you say that there is an aggressive amount of cuts priced in, with at least 150 basis point of cuts through the end of the year. Is there anything that you could see on Friday that to you would turn it from being aggressive to justified?
Well, they are going to be watching the data, as we are. You talked about the jobs data, you talked about the inflation data coming up. They're going to be looking at it. At this point, though, it does feel like the markets are pricing a pretty aggressive end to the year in terms of cuts. We're looking at about 1%, and with that hesitation between 25 and 50 at the upcoming meeting. So if you look at 1%, that means that we need at least 150 basis point cut at some point, because we have 3 meetings left. So it could be this time, and I think that will depend on the data that we see over the next few days.
Henrietta, tell us this. Good morning. We can get to what it is that shifts us to 50 basis points in a moment. The disinversion twice in the space of 6 weeks in the curve. How ominous is that?
Well, I think we're coming out from an extraordinary period, and I think some of your commentators this morning mentioned that. We have come out of the pandemic period. We have come out of a period of high inflation. As a result, that explains why we have the rates we have at the front end of the curve. So, in a way, this disinversion is more of a normalization, particularly if the central banks manage to engineer this sort of soft landing that we're in at the moment.
It might be just a normalization, Henrietta, but there has been a sense of maybe panic is too strong, maybe a little mini panic. On Tuesday, what you saw with both equities, yesterday, bond markets. Through it all, credit has been so resilient. Sure, spreads widened ever so slightly, but some $43 billion, the third most on record, priced on Tuesday. You had another $30 billion just about priced yesterday. What do you make of the resilience and the appetite and the ability for corporates to still issue into the volatility?
I think that's really positive. Obviously, companies are able to fund themselves at this point in time, and you do get that investor appetite. And I think that's linked to fixed income assets in general. I think they're starting to behave as you expect them to. Particularly on the rate side, you're seeing that diversification element. We saw it in August. We've seen it again in the volatility that we've seen in the last few days. And I think that is giving comfort to investors there. If you look at the spread side, yes, I mean, they are reflecting the benign environment that we're in at the moment. Yes, you had a bit of widening, but as you say, it's not that much. And credit markets have been very well behaved. So I think those are the sort of drivers that we're seeing. Enthusiasm for fixed income again at this point in time, particularly as we expect short rates to go down again. That boosts the attractiveness on the sort of longer fixed income side.
Henrietta, you've moved to tactically long. We are seeing a move a little bit more defensive in equity markets. Where is the defensive play on the curve? If the short end has moved so aggressively, is it the belly of the curve for you?
Yeah, I think the intermediate part is an interesting place because it does sort of tend to move around and gives you a bit of opportunity from a capital appreciation perspective, and you get a bit of the yield without sort of necessarily going too long out on the curve at this stage. So yes, we quite like that area of the curve.
With that attractiveness, and you say that it's more wide, people are more interested in fixed income. Is it enough to finally eat into cash holdings? Because Henrietta, we've heard from so long about the reinvestment risk at this period. Are folks finally starting to wake up to that?
Interesting question. I think we're going to have to see the first cut for that to happen, I'll be honest, and then they'll see that it's real. So I think we're very close.
Look, we're seeing some shifts across asset allocation, pulling out of tech and equity. When you look at the flow into credit and bonds, how would you describe the structure of the market at the moment?
We're certainly seeing a lot of interest from institutional investors at this point, and reallocations in their portfolios there, and a sense of looking for that diversification, looking for income as well, and looking for diversification in terms of their fixed income allocations as well. So they're not necessarily putting all their eggs in the same basket. They are looking around the fixed income markets for opportunities and benefiting from that diversification.
What difference does it make to them when you have a bond market that has been quite volatile? You have a front end that can move more than 10 basis points on JOLTS data, which is usually the staid, calm part of your portfolio. How does that change allocations when all of a sudden you're faced with more volatility?
Oh, come on. The real volatility test was in 2022. At the moment, yes, it's moving around, but I would argue that it's a much smaller range. And you have much more of a cushion from an income perspective. So I think that's the attraction on the fixed income side, and that's very different from the sort of real volatility that we saw in 2022.
Henrietta, we started this conversation with Van, our correspondent on the bond market, talking about where the destination was. Oaktree with us, that quote from Oaktree, we're going to end up in the threes. The Taylor rule says that you can cut by, 215 basis points. If Goldilocks holds, what kind of cycle are you now estimating if you're tactically long?
At this point, I think that's what we're seeing as positive is that central banks have got a lot of ammunition in their conventional tools, and that's very different from what we had post-financial crisis. So we see that as a good thing. Obviously, they need to be careful in how they yield it, but it means that they've got room to cut over the next few months. So we think that we're going to be in between what we had post financial crisis. We don't think we're going back there. We don't have the sort of leverage and conditions for that at this stage, but equally we're probably not going back to the sort of days pre-financial crisis where you had a higher neutral rate. So somewhere in between and around 3% doesn't sound like a bad place to land if we keep the sort of growth prospects that we've got at the moment.
A lot of mortgage holders would be happy if we can get to 3%.
Exactly.
Exactly. It would be welcomed, I'd say, globally. Henrietta, thank you very much. Henrietta Buckamore, Allspring Global Investments. Other stories trending on your Bloomberg terminal this morning. Tesla plans to launch its full self-driving in China and Europe in the first quarter of next year. Tesla AI, it's an affiliate of Tesla, says FSD, as the company likes to call it, will roll out pending regulatory approval. The company got approval in Shanghai to test the system earlier this year.
Samsonite has selected JP Morgan and Morgan Stanley for its dual listing in the U.S. The luggage maker is hoping to improve its liquidity, draw more investment globally. Now, other banks are looking to join the lineup. Samsonite currently trades in Hong Kong, but it may make the U.S. its primary listing.
The London Stock Exchange has said that Burberry will be dropped from the FTSE 100, ending a 15-year presence on the benchmark. The luxury British fashion house, with its distinctive beige check worn by celebrities like Billie Eilish and Lewis Hamilton, has a capitalization below the level required after its stock declined by more than 3/4 since hitting a record. That was April last year.
If Lewis Hamilton can't save it, then nothing can. Coming up, Nippon Steel's takeover of U.S. Steel is in jeopardy. President Biden is preparing to block the deal. We're going to have more on that next.
And later in the hour, 25 versus 50, we speak to HSBC's Nicole Inouye on the Fed's rate path. Context matters on Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
It's Bloomberg Brief. I'm Manish Granny alongside Danny Berger in New York. President Biden said that he's preparing to block Nippon Steel's $14 billion takeover of U.S. Steel. U.S. Steel responds with a statement in writing. We continue to stand by the fact that there are no national security issues associated with this transaction. We fully expect to pursue all possible options under the law to ensure this transaction. Nippon Steel, they stood by the deal as well. We have been clear with the administration that we do not believe that this transaction creates any national security concerns. Kriti Gupta is with us. This is going to turn into and is a hot political issue, Kriti. U.S. Steel are warning that thousands of jobs could be at risk if this deal doesn't go through.
Manus, this is an American manufacturing institution founded by none other than J.P. Morgan itself, the bank, and the man that the bank is named for as well. This is the company that has provided the steel of so many American bridges, American landmarks, not to mention a lot of the steel that is still there as a part of New York City. This is why it's a concern, though. This is a company and a sector, by the way, that has been bleeding employees, bleeding market share since its heyday back in the 1920s. The problem here is that they really need this takeout offer to stem some of those losses, and that's where you're seeing a lot of pushback, to your point, from the political landscape. The idea here simply being that this could be a deal that sets the precedent not just for the manufacturing sector and not just for U.S. Steel, but for other takeover offers as well from international companies for American companies, whether that's U.S. Steel, whether that makes up a big chunk of the economy or not. And this is, of course, something that's already seeing a lot of pushback from the likes of the Rust Belt, where Kamala Harris and Donald Trump are both trying to win over some votes. I should also mention this is crucial in that U.S. Steel has already made the comments that if this deal does not go through, they're already talking about closing plants and laying off even more workers.
Well, speaking of pushback, there have been many in the investment community, and Axios reports this, that the PACs have been getting more money from the investment community, specifically private equity, towards Republican candidates throughout the ticket versus Democrats. And part of that is about taxation. And Vice President Harris spoke about part of her economic plan and taxation at a campaign event in New Hampshire. Take a listen.
If you earn $1 million a year or more, the tax rate on your long-term capital gains will be 28% under my plan, because we know when the government encourages investment, it leads to broad-based economic growth and it creates jobs, which makes our economy stronger.
So more than the current rate, less than Biden had proposed. What kind of picture is she trying to carve out, Kriti?
She's trying to basically assure the business community, the economic community, that she is a markets-friendly and a business-friendly leader. And this is coming, of course, on the heels of a lot of pushback from economists, from market participants as well, that her comments around things like price gouging or addressing price gouging or putting caps on things like housing affordability, or even to continue some of the acts that President Biden has talked about in terms of things like drug care pricing, will not actually be stagflationary. That is the criticism that she's fighting, not to mention that the Republican Party is largely considered a more market-friendly party. This is significant as well because you made the point that she's coming in with a 28% plan that is significantly less than Joe Biden's proposal. Joe Biden pushing as high as 45% on that capital gains tax rate, of course, at the discretion of whether or not Congress approves it. But this is also significant because it is an increase from the current 21% that we have right now, and could, to Kamala Harris's point, encourage or make or break the appetite that you're seeing for investment. This is a way to appease some of the voters, bring some of the Republicans on her side, and also to reassure the financial community that she may actually be a positive when it comes to those policies.
Kriti, appreciate it. That is Bloomberg's Kriti Gupta. Okay, let's get a quick check on commodities this morning, because, Manus, there is a slight whiff of an attempt to come back, not as forceful as you would hope, considering crude had just fallen to its lowest level, I believe, of the year yesterday after a big sell-off on Tuesday.
Yeah, and look, we had this story yesterday that OPEC Plus may reconsider the amount of oil that they're going to put back into the system. And of course, look, you know, they backtracked on that as soon as they announced it. It can be paused or reversed at any time. So I think that that's the narrative that maybe just creates a bit of a floor. You check out gold, obviously, still around that 2,500 level, but lots of views in terms of China growth coming through as well. Lots of cuts coming through over the past couple of weeks.
Yeah, it's dourness about China growth. It's also concern about supply coming back on the market with Libya. And as you say, whether or not OPEC will actually pull back on some of their supply. We're going to talk about China demand coming up, specifically in luxury. Tiffany's is shifting gears. They are downsizing. We'll have that next for you on your brief.
invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
It's Bloomberg Brief, Danny Berger and Manish Cranny in New York. Let's get you some front page news, a look at what's making headlines around the world. First up, on the New York Times front page, Liz Cheney has officially endorsed Harris. Of course, she's been very critical of Trump for some time now. She was a Republican House of Representatives member from Wyoming previously. She now joins Adam Kinzinger, the former Illinois congressman, and Jeff Duncan, the former lieutenant governor of Georgia, as Republicans endorsing Harris.
Yeah, and she talks about as a conservative and someone who believes and cares deeply about the Constitution. Interesting kind of nuance there from her. Next up, we've got the Financial Times. US and Britain and Brussels, they're going to sign an agreement on AI standards. A big shift here. It requires more than 50 signatories to be accountable for harmful, discriminatory outcomes of AI systems and provides legal recourse for the victims. Now, the companies worry that a patchwork of national regulations could hinder innovation.
Wonder what Musk has to say about that. He's been calling for AI regulation for some time now. Now, finally, as Mana spotted this one, Tiffany's is planning to downsize a flagship store in Shanghai. It is more than 12,000 square feet, and Manis, the company, just points to weak China spending, a story we've heard over and over again.
Look, I think this has a global reverberation. Of course, Louis Vuitton took over, Tiffany's here in the US. But look, there's a fanfare in China, and they've asked for a 50%. They're going to halve the footage, and they've asked for a discount from the landlord. It's tough and hard luxury. Hard and soft luxury is going through a pretty tough time.
But it's all China. I mean, there's been so much dourness about China. J.P. Morgan, the latest to downgrade stocks in China, saying the impact of a potential Trump War 2.0 could be worse, saying that it could be more significant than the first tariff war.
And that takes you back to a host of downgrades on growth. Last week, we covered this. UBS have a 4% growth target for China going into next year. Yeah, they're shaving back this year, but let's face it, there's 3 months left of this year, and the iron ore market pretty much tells you everything you need to know about the outlook there. We're going to talk to HSBC in just a moment. Your equity outlook on Bloomberg Brief.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power. This is Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger alongside Manish Cranny. Let's set your agenda.
Bond traders raise their bets on a jumbo rate cut. 50 basis points could be in play. More data on deck. A brief disinversion in the yield curve. Softer jobs data challenges the Goldilocks narrative. And to Washington, VP Harris unveils her capital gains tax plans as POTUS gears up to block the foreign takeover of U.S. steel. Danny, good morning. It's a normalization of this curve, according to Henrietta, not an ominous sign.
It might be normalization, but it still feels shaky. It still feels fragile. If we can react so much off of JOLTS data. We fall again today in the pre-market session for U.S. equities, but barely, down about 0.1%. All things considered, considering what happened in the bond market, we weren't too negative yesterday on S&P futures, down by about 0.1%. Two-year yields, those little change this morning, 3.7%. As you say, Manus, a very brief disinversion, but we are now almost at even odds of a 50 basis point cut come 2 weeks from now. It all depends on the jobs data, but one thing certainly helping the long end has been what's happening in commodities. Crude up again 1% this morning, but before that down for 4 consecutive days to the lowest level since June of 2023, Manus.
Well, Danny, the narrative about this jumbo rate hike, I mean, it was a really outsized move and response at the short end of the curve, down by 10 basis points. And the Fed were so reluctant to, get on the hiking track. It just raises the question whether Powell really will be able to galvanize the committee into cutting that hard, that aggressively. And as Henrietta said, this cutting cycle, or what's priced in, is quite aggressive for her at the moment.
I just wonder what the politics of cutting 50 basis points in September, right before an election, would look like for the Fed, especially if it's not a unanimous decision. Sure, we have more Fed officials saying that they want to cut, that the market looks ripe for it, less so saying 50. The language has been gradual and taking their time, Manus.
Yeah, I mean, look, the other ominous sign that we had yesterday was this disinversion. I mean, lots of people were saying it was an ominous sign that you had this disinversion in the yield curve. Henrietta Parker was saying, no, it's a little bit more normalization. Well, history might show you something a little bit different. But let's talk a little bit more to our guests. We are counting down, we had the jolt yesterday. We were jolted by the JOLTS data, excuse the pun. The markets are counting down to the jobless claims later this morning and the payrolls report, as Danny has been saying, on Friday. What does it take to move them? Our guest this morning is Nicole Inouye, head of America's equity strategy at HSBC. Nicole, good to see you. There was a powerful repricing in the short end and across the curve yesterday in the bond market. That challenges the Goldilocks narrative. From an equity perspective, are you jolted? Are you a little bit more spooked about the Goldilocks narrative?
So, we still have the base case that we're going to have a soft landing scenario. We don't expect a recession in the U.S. We're expecting 3 Fed rate cuts, 25 basis point each. But really the focus is going to be on this jobs data on Friday. We don't expect a deterioration. We expect unemployment to actually improve a little bit on Friday. But if we do see this deterioration similar to what we saw last month, I think that will definitely spook the markets a bit. I think that will push the markets think that the Fed should cut 50 basis points. So I think, really this is what the market is focused on Friday, the jobs data. But, again, what we're seeing is a slowing in the labor market, a slowing in the economy, and really not this, a breakdown in the consumer or fears of a recession. So, that's still our base case. But, I think this market is extremely data dependent, really reacting on just single pieces of economic data coming out. But really that remains our base case, which is very positive for equities at the end of the day.
Yeah, it's this feeling of trying to find a new trend, Nicole, and we're so volatile as we do that. And in that trying to find a new trend, Scott Rubner of Goldman Sachs says that on Friday, should the jobs market data be weak, it will be the start of a correction in equities, because a weak data point would meet seasonality, would meet with positioning, would meet with a blackout period for corporates. I just wonder what you make of that call. Could there be a correction among equities if there's a weak report tomorrow?
Well, I think the market is definitely very skittish, very jittery. So, we've seen this roller coaster ride over the past month, where we saw a huge sell-off after the weak jobs report a month ago, and then we saw a very quick recovery. So one of the fastest recoveries we've seen since such a sharp sell-off since the beginnings of the pandemic. So, I think definitely if it's weak, the market's going to react to it. But, at the end of the day, when you're looking at equities, you're looking at corporate profit growth. And what we saw in the second quarter was a very good earnings season. We saw a lot of companies beating on estimates, almost 80%. And the guidance that the companies is giving was still positive. So, we're going into kind of this third quarter with, expectations okay. The company guidance is pretty good. And remember, the market is already expecting a significant slowdown in GDP growth in the second half of the year. And so far, the second quarter, we saw excellent GDP growth. So I think there is room to surprise if GDP comes in better than expected. And that would mean room to surprise also on earnings. So again, I think we will go into the next few weeks a lot of volatility, not only looking at once the Fed cuts, the question will be, okay, well, what's going to be the magnitude of this Fed easing cycle? And then, of course, we go into elections and other things that will bring volatility to the market. But at the end of the day, I think corporate profit growth should stay pretty strong.
Well, look, one thing is when you take out the Mag 7, the earnings in the rest of the index were healthy, you say, up 9% year on year, probably one of the best quarters that we've had since when? Since 2022. And this plays to a narrative Danny and I have talked to a lot of guests about whether it's time to become a little bit more defensive with those kind of earnings and rotate. Is it too late, or do you actually take action now to go defensive?
No, I think you go defensive if you're worried that we're going to get a recession, and we've written about that. If you're worried about recession, you go into staples, you go into healthcare, maybe you go into software. There's certain sectors that if we go into recession, we think that they'll stay pretty resilient. But what we're expecting now is really, since we're seeing this broadening of earnings growth, so it's not just a tech play. You're seeing financials, you're seeing utilities, you're seeing healthcare growing at similar earnings growth rates than ads tech. So we think going forward, you should be positioned into being more, broadening your exposure to other sectors within the S&P. It's going to be less just a tech-focused rally, and we're already starting to see this. And again, if the economy stays strong, stays resilient, we have no recession, Fed rate cuts, that's a very powerful combination for equities. And in the past, you usually see the S&P rally when we have this sort of scenario.
Within the consumer sector, though, Nicole, there have been strong earnings and there have been very weak earnings. Dollar Tree yesterday fell some 20% after cutting their outlook, following their peer Dollar General in doing that as well. Looking at these discount retailers, can you take any macro stock-wider signal from them, or are these isolated idiosyncratic earnings?
Yeah, so we've written a lot about the consumer, about the K-shaped consumer, about the high-end consumer still performing very well, the low-end consumer struggling. And within the consumer sector, you need to find kind of these pockets of strength. So, you have a certain situation where some companies focused on a low-income consumer is underperforming, but you have other companies that you're seeing they're benefiting from a trade down. So they're benefiting from a middle income consumer trading down. They're benefiting from share gains. They're benefiting to have more traffic into their stores. So within consumer discretionary, it's really a stock picker's market to find those areas of consumer strength, those pockets of consumer strength. And I think when we start to get rate cuts, those areas that have been weak within the economy, so the housing sector, the low-income consumer, I think those we can expect to see a little bit of improvement as rates come down, because that will give some relief to where we're seeing weakness within the economy, within the consumer specifically.
Nicole, really wonderful to get your thoughts this morning ahead of a very important day tomorrow. Nicole Inouye of HSBC. Coming up, shares of U.S. Steel slowly climbing back after a double-digit plunge yesterday. We're going to have more on President Biden's plan to block Nippon Steel's takeover bid. That coming up next.
Countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Principles, our policies in support of the Palestinian people will never change. Our policy in having a two-state solution will never change, and nothing will compromise it. And as long as we are, having the capability to be helpful, we will do it. We did that between Afghanistan, between Taliban and the U.S. We did that between different parties in Lebanon and Sudan and others. And that's basically the core of our foreign policy. It's been built based on mediation, on trying to help in resolving conflicts between the party. There are countries or people might not like it, but we don't ask everyone to like it, just to understand it.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Welcome back to Bloomberg Brief. I'm Danny Berger alongside Manish Krani in New York. So President Biden is preparing to block Nippon Steel's $14.1 billion takeover of U.S. Steel. That, according to people familiar with the matter, U.S. Steel responded in a statement writing, quote, "We continue to stand by the fact that there are no national security issues associated with this transaction. We fully expect to pursue all possible options under the law to ensure this transaction." Nippon Steel standing by the deal deal too, saying we have been clear with administration that we do not believe this transaction creates any national security concerns. Joining us now is Bloomberg's Derek Wallbank. Derek, it's not only those statements, it's also U.S. deals saying that they'll have to let go part of their workforce should the deal be blocked. What is the political calculus behind this?
It's a tricky one, Danny, because you have to ask which part of the political calculus are you looking at, right? The first part of it is that Pennsylvania is arguably the most important swing state in the upcoming elections, right? Donald Trump has vowed to block this deal. Joe Biden's, as you quite rightly said, signaling that he would kill the deal if and when it lands on his desk. Okay, so both of those seem like they're in some alignment trying to go there. But then, as you say, there are these questions about consequences for the company. And that's not just like some random idle thing. I mean, you would have that sort of talk anyway, but you did see a pretty substantial market reaction, right, to this news. And so there is some real concern, I think, that there could be negative outflow effects if this is rejected. The second thing I've got to talk about, though, is that Japan is a partner in the Pacific for the United States and has been one of the key partners that the U.S. has been reaching out to in terms of, well, everything, right? Taiwan, in terms of the Quad defense partnership and things like that. And it's very, very difficult, I think, for the U.S. to make the case from a foreign relations perspective to the Japanese, who have grown ever closer to the U.S., that they all of a sudden, one of their companies would be a national security threat to the United States. I think that is a very difficult posture and it's a very difficult political diplomatic dance.
Yeah, well, certainly the digital transformation minister is already saying that they're all just hunting for labor union votes. So this could really have a whiplash effect in this campaign. But of course, we get more information. Vice President Harris, she spoke about the economic plan at a campaign event in New Hampshire. Let's take a listen.
If you earn $1 million a year or more, the tax rate on your long-term capital gains will be 28% under my plan, because we know when the government encourages investment, it leads to broad-based economic growth and it creates jobs, which makes our economy stronger.
Now, Derek, it depends which way you thread this needle. One could say her plan is less than Biden's. It's an olive branch, but it is up from 20% at the moment. So again, it is a revenue-raising proposition. Politically, it's a solid vote winner in these swing states.
I mean, politically, Bannis, you got to look at it and you say, okay, am I willing to lose everybody over $1 million a year to gain people under $1 million a year? And math says that taxing the rich and soaking the rich is a popular thing to do. Now, I think one of the realities that Kamala Harris is looking at here is that among the Democratic base, certainly there is a view that a lot of the money that comes in at the higher income levels is coming in ways that are currently escaping the U.S. tax code, right? The idea that above a certain income level, capital gains are your chief source of income, right? Not actual salaried labor. And we can go through any number of executive compensation deals to sort of go at that point. The other thing that I have to mention here is that part of where this is getting additional resonance, right? You sit there and you think, oh, well, how would this get through Republicans in Congress? Remember that the tax code is being opened next year, right? There's so many expiring provisions in the last Republican-backed tax law that do expire, and there's going to be a very big negotiation about potential pay-fors. So what Harris is really doing here is not saying this is exactly what would go through, but sort of laying down on the table, this is one of the areas that we may go after. We may talk about capital gains on high-income earners, and yeah, maybe it doesn't end at 28%, but maybe putting it up is in play in order to pay for something else, because all of that conversation and all of the we'd love to do tax cuts for insert people here is going to play out against the backdrop of how much do you value deficit spending and that sort of argument. So all of this is going to go into the mix, and consider this like an opening bid with political ramifications that people who do have
a lot of capital gains income and are in those higher income brackets will really be needing to pay attention to, particularly next year.
Yep, well, at the moment, we're on the headline level. Let's see what translates. It's counting down to that election day. Derek, thank you very much. Derek Wallbank on the very latest from Kamala Harris's tax propositions. Another stock we're keeping an eye on, it's Tesla, is planning to launch a full self-driving system. The FSD in China and in Europe, it's going to be in the first quarter of next year. Tom McKenzie is with us. Tom, the rollout, I mean, they've had some trials, but this seems to be quite an announcement in terms of full self-driving on the European roads. I mean, do they have the political backing for this?
Yeah, look, this is really consequential. In terms of the details, FSD, by the way, full self-driving, Tesla admits this, it's not actually full self-driving, it's a level of autonomy that gets you closer to that. So the naming is a little off, but Tesla have acknowledged that. It's consequential because they charge about $8,000 a year for a subscription to this in the US. So it's a potential additional revenue driver for them, both in Europe and in China. The China part's really interesting. Elon Musk made a trip there in April. He was going to go to India and meet the Prime Minister Modi there. He decided to ditch that and go and meet the Premier of China instead to push for this and lobby for this. He's made a couple of tests in China. He's had to sign a deal with Baidu on the mapping component for this full self-driving autonomy. And he's had to come up with some assurances for China around data and privacy concerns, data security and privacy concerns. It seems like he has either met those, or they have either met those, or will be meeting those soon, because he's looking at that rollout in the first quarter of next year. So what do they get from this in that market? Possibly that $8,000 additional, depending on how they price it in terms of the subscription for this, at a time when, of course, they've cut the price of their models in that Chinese market. They've seen their market share go from about 10% to about 7% by the end of last year. The first 8 months of this year, they've seen sales fall by about 6%. So they need those additional revenues from their largest overseas market. They will be hoping that FSD and approval on that front will get them there.
Well, to that point, Tom, it's such a competitive market in China and Europe with the cheaper Chinese vehicles. To that point, Volvo Cars, we learned early yesterday, it's abandoning its goal for all-electric lineup by 2030. They also announced a profit outlook cut this morning, in part because of scaling back of EV goals. How do these EV makers stand up unless there's something like a Tesla that can offer a new product?
Yeah, Danny, I noticed you're wearing a nice and bright shade of green today. Volvo wearing a slightly murkier shade of green. They were really symbolic. One of the first companies to come out and say, we are going to be fully electric. They gave this target of 2030. They've now walked that back. Not hugely, but they give themselves wiggle room of around 10%. So they'll say by 2030, they'll be 90% of their way there. They may be 10%, which will be plug-in hybrid, so not fully electric. They've also walked back some of their emissions targets for their vehicles as well. And again, it's modest, but it's hugely symbolic given where Volvo were in terms of being first out of the gate in setting these targets and how essential it is for that business in terms of how they market and brand themselves. And it's a reminder of the slowdown generally in demand for EVs here in Europe, given, again, the competition we're seeing from China, the lack of support from the state. Will that change? One to watch.
Tom, I just need to clarify, my trousers are indeed bright green. I realize on this shot you only see my top, which is black, which might lead people to think you're colorblind, Tom, but he is not. Tom, thank you so much for that. Bloomberg's Tom McKenzie. Okay, coming up, we're going to set you up for your trading day on this Thursday. More data to come.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Always on the heartbeat of the tech spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure. Don't miss Bloomberg's interview with the
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
It's Bloomberg Brief. Danny Berger and Manus Cranny in New York. Let's get you set up for your trading day on this Thursday. And it is a data-packed one, especially in the 2 hours, starting with ADP at 8:15 a.m. Jobless claims will come at 8:30 a.m. Then PMIs at 9:45 and ISM services at 10. Then former President Trump will be speaking at the Economic Club of New York. That happens at noon Eastern. Plus, we're going to get some earnings, specifically Broadcom, after the market close, Manus.
Never far from a little bit of an earnings sheet. In terms of the data that you mentioned there, Danny, let's get back to Ven Ram. In terms of the outlook, Ven, we're counting down to the jobs number, obviously, tomorrow, ADP and jobless today. Pretty powerful jolt in the response from the bond market yesterday to jolts. What are we going to be focused on today?
Well, I would be focused on the ISM services number for the simple reason the ADP number, as you know, is forecast to show an improvement. But if you look at it in the context of the recent PLS downward revision, the markets are likely to be skeptical about any improvement. So I would rather look at the ISM services number. I think that if that shows a weaker number, then the market's fears will be doubly compounded coming on top of the JOLTS report and ahead of the non-farm payrolls report. So I think the services PMI is what I'm looking at.
For people who like to look at asymmetry in this market, Ven, given the bond market rallied to start this week, given that equities sold off, how are we set up into these data points?
Well, I think that the risk is towards some profit taking in treasuries, particularly the front end. The front end has rallied a whole lot, and at 377, it's discounting the Fed funds rate by a whole lot and then some. And as for equities, they remain frothy despite the correction. I mean, if you look at the fair value on NASDAQ, it's somewhere around 12,000, and now it's trading, despite all the correction that we have seen, it's still, there's a 50% gap between its fair value and where it is trading. So I think that the traders are likely to take money off the table first and ask questions, if any, later.
Yep, shoot first and question later. Then, and if you listen to Goldman Sachs, I mean, they're basically saying in the down market, these CTAs and the flow traders could tank $65 billion worth. So it is about momentum there as well. Ven Ram with the setup to the services number.
Yeah, they say a correction could start, Goldman, that is, if there is a bad number. Okay, that's it for your brief surveillance. That's up ahead here on Bloomberg.
2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is we built essentially from scratch, you know, with lots of supporters, a really mind-blowing level of innovation against emissions. And, you know, in the last 9 years, that's gone better than I would have expected. So only now could you even, you know, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up very like the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. You know, in the meantime, some people who care about this issue are really out, you know, trying to think, do we need permitting reform? You know, do we find, what new ideas haven't we found yet? You know, how do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
We actually think that rates at the current levels are too restrictive given the slowdown in activity that we have seen this year.
We're not expecting a collapse, but there is no doubt the consumer's slowing.
Not much has changed with the consumer over the last 6 months. They're employed, wages are growing, but they are being choiceful.
The direction of travel is towards a weaker economy. We shouldn't be surprised by this.
Growth looks good now, but we do see slowing going forwards.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, waiting for the appetizer to Friday. Your scores look like this. Equity futures on the S&P 500 shaping up as follows, just about unchanged on a 2-day losing streak. On the Nasdaq 100, down by 0.2%. On a Russell, the small caps a little softer, also down by 0.2%. Your day ahead, a sneak peek, it looks like this. 8:15 Eastern Time, the ADP report. 8:30, initial jobless claims. Then 10 a.m. Eastern Time, Lisa, and ISM services print.
These numbers are going to be actually especially important, not only because of the jitters that we've seen in markets, but yesterday's JOLTS data, which for the same month that we got the jobs report in August, the July numbers that really showed weakness. Do we see current data that confirms that, this feeling that maybe there is this sort of protracted weakness that's going to require a bigger response from the Fed and potentially could be something different than what the market's price?
Don't you think the echoes of early August are growing? Just to compare and contrast, ISM manufacturing, back end of July into early August, people start to get nervous. Jobless claims, people start to get nervous. The jobs data going into the big one, payrolls, and then we get that payrolls report. How close are we to repeating what we already saw a month ago?
This is what a lot of people are talking about, including Mike Wilson, the sense that bad news is bad news, and we're seeing that bad news percolate from a number of corners, but weakness does not mean weak. And there were a number of positive data points, like the quits rate that went down yesterday. It's not as though the sky is falling, and anecdotally from companies, yes, you are seeing cooling, but it's not as if there's a mass group of layoffs that are being planned. You even heard that in the Beige Book, which I actually thought was quite interesting. But looking forward, here's the issue. Are we set up just a touch differently given the outperformance of the equal weight, given the sort of cyclical rally that we've seen so far?
You can feel the anxiety, though, over the last few days. Selling stocks, buying bonds. Your 2-year yield at the moment, 377. Your 10-year, 377. We can talk about the shape of the curve in just a moment. I want to talk about payrolls tomorrow as well. Just to go through some of the estimates for you. 165, still the median estimate in our survey for headline payrolls. Beneath the surface, the focus elsewhere, I guess, is going to be on unemployment. Looking for that unemployment rate to come back from 4.3 Anne-Marie to 4.2%. And maybe for many people, that's going to be the data point they put more weight on.
Right, because now you have everyone asking Fed officials, if you are seeing weakness like Mary Daly, in the labor market, is it enough to potentially go 50? And she said she was unsure just yet. Not just unemployment. Drew Mattis yesterday, Jonathan, told us also hours worked. Because if more people are working less hours, potentially that means it's finding harder to find full-time, more hours worked, and likely that means layoffs could be on the way.
What's the North Star for this conversation? It's one quote from Chairman Powell in Jackson Hole, Wyoming. We don't seek or welcome further cooling in the labor market. Was yesterday evidence of further cooling in the labor market?
Some people said yes, simply because you also saw the ratio of job openings to the unemployed falling to below levels in 2019. There are a number of data points that are coming out that edify what Jay Powell had to say about the market being looser than what we saw pre-pandemic, which is a concern for them given what some of the trends have been. That said, and I go back to the Beige Book. I go back to my conversations yesterday with CEOs. None of them are talking about things falling off a cliff. They're talking about expansion. They're talking about growth. They're talking about consumers that have not yet dropped off the map. To me, this sort of represents the confusion of this moment. And the anxiety that you're feeling in markets is it never happens linearly. You never see it like this, and then that's it. But there is a feeling that maybe, this time is different.
For every CEO that you found, I can find you another one that says something totally different, and that's the problem, right? A Dollar Tree, a Dollar General. The struggle's there. Painful, painful stuff for those two companies in the past week or so.
And that actually raises even more concern because those cater to some of the lower income families. But if you take a look at the Beige Book, okay, let's just sit on this.
Well, it's the third time you've mentioned this, so go for it.
Look, I think that people underestimate the difference in the commentary from Boston, from New York, from St. Louis, from Atlanta. Some saying things are fine. You saw that in Richmond. Meanwhile, you're seeing in St. Louis reducing profit margins. Chicago, further weakening of demand could result in future layoffs. In New York, hiring has shifted primarily for replacement. I mean, these are actual tangible feelings of difference between the regions, but in general, 9 of 12 cooling. To me, that's actually significant.
Employers were more selective with their hires. That's what stood out to me. They're hiring, but they are choiceful and they are selective. Not falling off a cliff, but it is slowing down.
What do we think of this word choiceful? How many times have we heard this word choiceful? How many times did you hear that word at the Goldman Sachs Retail Conference?
You want to know my honest opinion? No one's listening. I don't like that word. Are they being choosy?
Now there's Jonathan.
Well, I'm sorry. Just choiceful, what does that mean?
You
I'm
put
full
lipstick
of
on a
choices.
pig. It sounds like it's got positive connotations, right? It doesn't. It doesn't at all.
It's like you're voting. You're choiceful. Like, I've got a lot of choices. I can make choices. It's a capitalistic society. No. Are they choosy? Are they struggling? Give me something that actually means something.
Picky.
Picky. They're struggling. And no one really wants to just say that, right? If you're a CEO, isn't it better just to say the consumer's choiceful right now?
Yes, it's another way of saying, they've got discretion and it's more competitive to get their dollar. I just am trying to figure out how much they're actually having to reduce prices and shrink margins versus not. I don't know how much is marketing too. If things were really falling off a cliff, they would have come out with a much more negative picture. Otherwise, they would have had a trouble explaining away their disappointment.
It's great to have you back. You were missed.
Thank you.
I've missed the rant, that's for sure. Equity futures on the S&P 500, just about unchanged. If you are just joining us, welcome to the program. In the bond market, plenty of price action for you. 376.65 on a US 10-year. The 2-year basically in line. The 2-year 10-year curve turning positive on weaker jobs data yesterday. Lisa, for only the second time since 2022, but still struggling to close at that level.
Yeah, and it closed at that flat level for the first time, as you said, in more than 2 years. Question to me is this a good sign or a bad sign? We've typically seen this be a sign of actually recession, that when you have an inverted yield curve and then it does disinvert, that typically is when the recession starts. At this point, though, you're seeing it at the front end. Basically, the Fed is expected to come in and cut rates really aggressively in order to save off the economy, and you're not seeing runaway activity on the long end. I don't know. I don't know what to make of this. I do know that this actually helps the financials, and that's what people are looking at.
Usually that's a sign of bad things happening in the US economy, and we can get some views on that for you throughout this morning. This hour we'll catch up with John Stolfus of Oppenheimer, with stocks coming off 2 days of losses. Isaac Boltansky of BTIG as President Biden prepares to block the Nippon-US steel deal, and Kathy Bosjancic of Nationwide on why she still sees a resilient labor market. We begin with our top story. Stocks looking to snap a 2-day losing streak as traders await jobless claims data at 8:30 Eastern and payrolls numbers tomorrow morning. John Stolfus of Oppenheimer looking to the data for a preview of the Fed's next decision, writing, "We are looking for a 25 basis point rate cut to be announced on September 18th, potentially to be followed by cuts of 25 basis points in November and December if needed. John is with us now for more. John, welcome to the program. Let's get straight into some of your calls in the equity market. We looked at Dollar General in the last week, Dollar Tree in the last 24 hours, highlighting the pain the consumer's going through, job openings dropping back down to levels we haven't seen for a number of years. And yet, John, you want to buy cyclical areas of the economy. What's behind that call?
I think what it is, Jonathan, is where we are today is we are in the process of a normalization, moving towards sustainable growth at a pace where we don't grow inflation too hot, and yet we do not destroy the labor market. And I think that you don't want to get defensive now. It's wrong time, we would think. So we want to own cyclicals. We want to be broadly diversified to take advantage of what has been a much broader rally across the 10 sectors since mid-year. And at this point, we would say, if anything, that the JOLTS numbers, if you look at the JOLTS numbers and you go back, I put them on my Bloomberg, and I went back from July of 2009 to July of 2018, which was a real period of recovery, moving through that. Then the average JOLTS was 4,608, and people got bent out of shape with a 7,000 number yesterday. I don't get it.
John, other people do get it, and they're buying utilities, they're buying staples, they're buying real estate. Why is that the wrong place to be?
I don't think it's the wrong place to be. I think you want to own some of them. I just wouldn't be overweight utilities or staples. And the performance on a year-to-date basis, on a basis of from the lows of October 5th, and in the rally points that we see, all favor cyclicals in a very definite manner. It's where you see the earnings growth, although you do see there's been awfully good earnings growth in utilities within the S&P 500, but a lot of that is likely the result of regulators allowing utilities to charge more as their input costs have gone up significantly over the last few years.
As you mentioned, the cyclical play has actually gotten quite a bit of attention, has actually done better and outperformed over the past couple of months. What hasn't is NVIDIA, which is down 22% since June 18th, since that peak that it saw then. Why not just hoover up NVIDIA at a 22% discount?
Well, you've got to say, what is it? I think the other day, I'm just hearing it's up over 100% since the start of the year, even with that pullback. You've got to figure that what we're seeing now is broader diversification being selected by investors after we've seen these narrow periods, narrow leadership with the S&P 500. And as we're in a period where the Fed has stated it's very much concerned about the labor market and doesn't want to hurt jobs in here, you're going to get a rate cut coming up earlier than we'd expected. It looks like September's good for 25 bips. And we think there's good chances, as you mentioned at the beginning of this segment, we're thinking 25 in November, a potential, and another 25 cut in December. It's as needed, as it says on the prescription bottle. But no recession yet, and more people believing we're likely to skirt or avoid a recession. So we think you want to own cyclicals.
So that's exactly.
We also think once the Fed begins to cut, you'll see a more sustainable a rally potential from small and mid-cap stocks, which have faded in and out during this period.
This is exactly where I wanted to go, because you previously thought that rate cuts weren't necessary in this economy, and the as-needed label on the bottle is being whipped out now at a time that as-needed is somewhat concerning to some people, particularly for cyclical areas that depend on a less choiceful consumer, one that is less sort of discretionary. How much are you concerned that it is as needed for the Fed to potentially cut rates as much as 50 basis points this month?
I don't think they're going to do 50. I don't think it's quite needed. The calls for 50 really come from more highly leveraged players than intermediate to long-term investors who tend not to be as levered. But the other thing is when you talk about the dollar stores, without getting in particular with either one of those, you've got to remember that a lot of their constituency has been supplanted by the likes of the bigger discount companies in the S&P 500 that have offerings that are more competitive and more attractive. Because in the case of the largest component in the consumer staples, when it comes to big box kind of shopping, they just have the volume to be able to get better pricing. So the fact that some of those stores that in another era would be really very popular on lower income, their offerings are probably not as attractive, and perhaps their managements have not worked as well as the larger companies that are clicks and mortar, or rather, mortar and clicks, or clicks and mortar, what have you.
Execution issues. John, thank you. Interesting last word there. John Stolfus of Oppenheimer. On the Federal Reserve, it doesn't matter what any of us think. It matters what they're going to do, which is why Mike McKee came on this program a little bit earlier this week and said that maybe the biggest event this week was at 11 a.m. on Friday. Why 11 a.m. on Friday? The quiet period for the Federal Reserve kicks off on Saturday, and Lisa, at 11 a.m. on Friday, there's a speech from Governor Waller a few hours after that Labor data drops. If they want to go 50, that's the moment to signal it.
Chris Waller is going to be the person who comes out and says, ultimately, we don't think the economy is falling off a cliff. This is just what I project the speech to be. Should we get a negative or sort of a disappointing payrolls report, this is what it is. Basically, he comes out and he says, we don't think the economy is falling off a cliff. We do think that it is overly restrictive, our current condition, and so we need to adjust by a measure that is representative by how restrictive we are based on the conditions, and we do want to make sure that the labor market is sustained and not deteriorate more markedly.
I wonder if Governor Waller was happy with that impression of him.
We'll
I like that you took a deep breath ahead of it too. Equity futures on the S&P 500 just about unchanged. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Nippon Steel's proposed $14 billion takeover of U.S. Steel has all but collapsed. Sources tell Bloomberg President Joe Biden will formally announce his decision to kill the deal as soon as the Committee on Foreign Investment formally recommends its termination. Both Nippon and U.S. Steel have suggested that they could challenge that. U.S. Steel has been warning that thousands of jobs are at risk. Nippon, for its part, made extensive concessions in recent weeks, committing to invest $1.3 billion in U.S. steel mills. Tesla says it will launch its full self-driving technology in China and Europe in the first quarter of next year. That pends regulatory approval. The Tesla AI account posted its release roadmap on X, outlining upcoming launches for each stage. That does assume, though, that Tesla is on track to gain permission from both China and Europe for the self-driving tech. Tesla sees it as a way to boost sales and stay ahead of its Chinese rivals, who are working on similar systems. Tiffany is planning to downsize a major flagship store in Shanghai. Sources tell us that the two-floor, 12,000 square foot store will mostly be vacated later this month, but its Blue Box Cafe will remain open. It has been an increasingly challenging business environment for global luxury brands that are facing a property market slump in China and a broader economic slowdown. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. It's tough in China for the luxury players, that's for sure. This from JP Morgan earlier on today, abandoning its buy recommendation for Chinese stocks. And the quote, here's the quote: the impact of a potential tariff war 2.0 could be more significant than the first tariff war. We expect China's long-term growth to trend down structurally due to supply chain relocation, the expansion of U.S.-China conflicts, and continued domestic issues.
This is a fascinating point at a time where every retailer is looking to continue its presence or even expand in China, even while saying their biggest concern, a tariff war.
We'll come back to that a little bit later this morning. Up next on the program, United over U.S. Steel.
United States Steel, an iconic American company.
U.S. Steel should remain American-owned and American-operated.
U.S. Steel is going to be sold to Japan. I wouldn't let it happen.
U.S. Steel stuck between a rock and a hard place. That conversation up next, live from New York this morning. Good morning.
Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
It's Jobs Day, and Bloomberg has the report under surveillance.
It's from super hot to solid.
This is normal.
I think people underestimate the behavioral aspects when it comes to the labor market.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
So what is bad on September 6th?
Nobody really has a full answer on it.
I don't know what counts as good news these days.
It's a big debate.
The August Jobs Report, Friday on Bloomberg.
Payrolls data just around the corner. And this morning as well, 8:15, an ADP report, 8:30, jobless claims. Equity futures into all of that. Just about positive on the S&P 500. Just about unchanged. In the bond market, yields higher by almost a basis point. The 10-year 376.46. Under surveillance this morning, United over U.S. Steel.
United States Steel, an iconic American company for more than a century, is going to remain an American company.
U.S. Steel should remain American-owned and American-operated.
The great U.S. Steel. U.S. Steel is being sold to Japan. I don't like that. U.S. Steel is going to be sold to Japan. I wouldn't let it happen.
Here's the latest. Republicans and Democrats agreeing that U.S. Steel should remain American-owned and operated. Bloomberg learning President Biden is preparing to block Nippon Steel's $14.1 billion takeover of the firm as soon as this week. Isaac Boltansky of BTIG writing this. The only lesson the market can take from this one is to get the wheels turning on high-profile deals well before we enter the heat of the campaign season, especially if the acquisition target has the historical significance and political weight of U.S. Steel. Isaac joins the program for more. Isaac, welcome back to the program. I think we have to throw in there as well the comments from U.S. Steel to the Wall Street Journal in the last 24 hours, making the case that without this deal, there will be job losses and the headquarters will be moved out of Pittsburgh. So the question I have to ask this morning, Isaac, is how do the campaigns change? Who makes the most compelling case that ultimately they can protect jobs without a takeover?
Yeah, look, I think watching that intro, it's almost heartening to see that there's such agreement among the political parties about this deal. It's just a shame that that agreement is built on protectionist soil, right? And I think that that's something that I think the market needs to take as a takeaway from this, in that had this deal been announced a year earlier or a year later, I don't think that it would have faced the same amount of political headwinds. And so I think when we start thinking about foreign direct investment more broadly, I think that we're going to have to start thinking about this from a timing perspective as well to try to avoid these large elections, especially for something as iconic as U.S. Steel, given the significance of Pennsylvania.
Isaac, if we do have the president come out and block this deal, once CFIUS gives that recommendation, hits his desk, we have to wait for that recommendation legally. What happens next? What does U.S. Steel do?
Look, I think that we have to assume there's going to be a lawsuit here. I think that first we're going to have to see what the legal reasoning is. And I've spent a fair amount of time on this. I don't see where the national security risk is. I don't think that there is a viable argument that there's a national security risk. I also don't think that there is any semblance of an argument to be made that Japan is a risk, but we're going to have to see what the reasoning is. A lot of time is spent at the CFIUS level on these things, and I'm still a believer that if you give lawyers enough billable hours, they can come up with any argument. So we'll have to see what we get from that. But my gut tells me that this is going to litigation, and I think that the companies have a good shot here, depending upon what that reasoning is. It's just time. It's time. They're going to burn more and more time. And at that point, you wonder if the calculus changes for the parties.
Well, they're working on high-end chips together. This is one of America's staunchest allies. So if CFIUS comes out and says that there is actually a national security concern with one of the biggest allies taking over and investing in a U.S. company, then what leg do they have to stand on in the future?
Yeah, look, if you can't sell to Japan, who can you sell to? Right? I think that this is something that I struggle with as well, because there's a cognitive dissonance here where we are trying to elevate and deepen our relationship with Japan in every way to counter China's rise. And yet in this one instance, because of the name of this company and because of where it is headquartered, this doesn't pass muster, right? And I think that's something that all of us are struggling with, because all we want is to know the rules of the road. Who can buy, who can push these transactions forward. And the fact here is this rejection doesn't comply with the rules of the road as we have known them. And I think that is going to have a chilling effect on foreign direct investment. And I think that it's going to add some volatility in markets where otherwise we would have had some certainty on the rules of the road.
Isaac, when I talk to executives, when I talk to analysts, there seems to be a belief that all of this that we're hearing being announced with its protectionist, potentially antitrust issues are mostly for the election. And after that, it will go back to what makes sense for business. Do you think that is true? Is that also something that you feel? And is that what history has shown?
I think that there are going to be small windows that you can operate in shortly after elections and before we get into the ramped up period of midterms and then presidential that we're always in an election cycle. And so, again, I think that this deal, had it been announced 1 year prior or 1 year later, maybe the calculus is different. But for my clients, and what I'm trying to argue here is there isn't much that unite the parties here. And this new virulent protectionist string that you're seeing both in the Republican and Democratic Party is something that I don't see going away. And so maybe you can time things up so that you're running through the CFIUS review right at the right time, maybe 6 months after inauguration, rather than a few months before the election. Perhaps you can time it up that way, but we are in a constant campaign season.
And it's not going to end anytime soon. Isaac, thank you, sir. Isaac Boltanski of BTIG on US Steel. US Steel yesterday down by more than 17%. I have to say, and we'll speak to an analyst about it a little bit later, I was surprised by the scale of the move. Who thought this was going through?
Yeah, well, and who's trading on some of the prognostications that we're hearing on campaign trails? Again, it just speaks to this lack of conviction and maybe even liquidity.
That name is slightly positive in the pre-market, up by around 2%. Coming up on this program, a brutal EV reality check for the auto industry.
the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Live from New York, welcome to the program. Equity futures on the S&P 500 just about unchanged. Some stability after a very choppy 2 days to kick off the month of September. Unchanged on the S&P, on the Nasdaq slightly lower by 0.14%. That's the stock market. Plenty of price action in the bond market. The bid is strong to start the month of September. The 2-year down to 376.62. The 10-year down to 376.46. The yield curve very slowly normalizing after being inverted for the most part of the last 2 years. This after job openings came out yesterday at the lowest levels since 2021.
Just to give you a sense of what's driving this, it has absolutely been the 2-year, dropping by a percentage point from its recent peak just a couple months ago. And yesterday it closed at its lowest closing level going back to September of 2022. This even as 10-year yields are just lower by about 0.5%, and you see them closing at the lowest level since 2023 in July. So here's the question that I have. Basically, is this a suggestion that the Fed is going to get ahead of any kind of weakness, cut rates aggressively, and keep the economy afloat? Or is this the belief that essentially we don't know anything about the long term? We can bet on the short term. The short term looks like the Fed has some room to cut, so let's go there. I mean, I don't understand how bullish versus bearish this type of move actually is.
We saw a movie that had a beginning like this about a month ago. The data came out, ISM manufacturing, soft. Then we had a jobs number. It was jobless claims last time around, came out soft. Payrolls ultimately came out and did the same thing. Then for the next several weeks, the next 3 weeks, we had jobless claims come out that came back down, lower. And that just put a lid on some of the concern. And I just wonder here we go again. ISM manufacturing, soft. This time job openings, lowest since 2021. If we get a payrolls report tomorrow and a jobless claims number at 8:30 that signals things are okay, do we put a lid on all this again? Does this reverse? Or have we gone somewhere now that we're not returning from?
My deep impression is we have gone somewhere we're not returning from, not in full, just simply because of we welcome no further weakening in the labor market. Those words by Jerome Powell, the time has come. This really highlights a shift in tone. We heard this from Mary Daly also. She thinks that policy is very restrictive. She supports a move and wouldn't say whether it was 25 or 50 basis points at the September 18th meeting. This indicates there has been a shift in the balance of priorities for a Federal Reserve that squarely believes that where we are is way too restrictive for the economy that we have at our hands.
As you get that move at the front end of the curve, check out the move in the FX market. 3 consecutive days of yen strength and dollar weakness coming off the back of the worst month for the US dollar of the year so far. Dollar yen at the moment at about 143.50. We're down by 0.2%. Just as you think we've cut the link between the Japanese yen and risk assets in the United States, people start to talk about exactly that all over again.
Well, the idea of how much of this trade has actually been unwound, given how much money has gone into the dollar trade. Also a question of how far this divergence can go between the Japanese economy and the U.S. economy. Who's driving the boat? On this level, it's both, because you got Japanese real wages unexpectedly rising overnight. So at the same time that you're seeing disappointing data in the U.S., you're seeing better than expected data or hotter than expected data in Japan. Point being, there's still a lot of work to be unwound fully if you do see that divergence continue to widen.
Dollar yen, 143.50. Under surveillance this morning, some top stories for you. Vice President Kamala Harris calling for a 28% capital gains tax on people earning $1 million or more. The presidential candidate seeking to ensure the wealthy pay their fair share, and drawing contrast with rival Donald Trump. Also drawing some contrast with the sitting president on this front.
Absolutely. He was embracing something closer to 40%. And I spoke to individuals close to Kamala Harris yesterday, and what they're talking about is they want to demonstrate that she is taking real steps to try to make sure that she's talking to the business community, showing the business community that she is a safe pair of hands. But at the end of the day, it doesn't really matter what Trump or Kamala Harris have to say on taxes. This is going to be the biggest fight in the U.S. Congress, and the composition of Congress matters so much more for the taxes of next year.
It's such a polite way of saying it ain't going to happen, so people aren't really paying attention to it. But
I'm diplomatic.
I mean, for me, they're really looking at this. It's sort of, Joe Biden playing mean grandpa, and then she can come in and play nice potential presidential candidate. And how much are they going to play off each other in this kind of way?
Mean grandpa. Can you imagine if he was still running and the Republicans ran with that?
That's why I'm not.
Where did that one come from?
Well, that was actually Libby Cantrell.
Is that what Libby said?
Or she didn't say that.
Are you blaming this on Libby now?
I'm not blaming this on Libby.
Okay, let's just move on. Let's go to a different story. Lisa's still digging. Let's turn to NVIDIA. Responding to a Bloomberg News report about the U.S. Department of Justice sending out subpoenas, saying it has been in contact with the agency, but it hasn't been officially subpoenaed. The company adding that its edge in the AI computing market stems from the superiority of its products. Now, there's some confusion over this, and Ian King here at Bloomberg, I think, has helped explain some of it in his story. So I'll just read his words verbatim. The DOJ often sends requests for information in the form of what's known as civil investigative demand, which is commonly referred to as a subpoena. The Department of Justice has sent such a request seeking information about NVIDIA's acquisition of Run AI and aspects of its chip business. This according to one person, Anne-Marie, with direct knowledge of the matter.
It sounds a little bit like semantics. What do you call something officially? At the end of the day, the direction of travel is obvious when it comes to what the DOJ is seeking from NVIDIA, and their concern about this company and the fact that they think it's basically has too much of an edge, too much of a market share, and they're concerned as well with this acquisition of Run AI. So they're digging into that, but I think the idea that they didn't get a subpoena potentially is just semantics.
Well, to me, of course they're being looked at. I mean, at a certain point, they're the dominant behemoth. They're the only game in town. Of course, people are going to look and see what kind of monopoly are they getting over this. Question is, how much does this potentially curtail their future growth, curtail their future business? Share price seems to suggest that people are worried about this, but it also could be that the shares are off 22% from their record high after still rising more than 100% so far this year. So hard to know how much to read into this, given the fact that it's almost status quo to be investigated by antitrust officials, by the DOJ, just by virtue of where we are in this particular policy cycle, as well as their dominance over the field.
There is a correlation between success and investigations in the world of tech, and always has been.
I mean, right?
Yeah. NVIDIA's up by 0.6% in the pre-market. The latest on the Fed, we've mentioned this a few times, the San Francisco Fed President Mary Daly telling Reuters the Fed needs to cut interest rates to keep the labor market healthy, saying that it will come down to incoming economic data to determine by how much. Her comments coming ahead of jobless claims later on this morning at 8:30 Eastern Time. Let's turn to this industry. Automakers turning to cost-cutting measures as headwinds mount in the EV industry. Volvo Car, the latest to change course, abandoning its target to sell only fully electric vehicles by the end of the decade. This coming as Volkswagen defends plans to consider factory closures in Germany for the first time in its 87-year history. On top of all of these stories, RBC's Tom Narayan. Tom, it's good to see you again. Thanks for coming in. The reality check for some of these automakers, VW coming out and saying we maybe got 2 plants too many. Are we about to go on a big cost-cutting cycle in this industry?
I think companies like VW have wanted to do this for a long time, right? I mean, they have these corporate governance challenges they face. Very difficult when 25% of your company is owned by the governor of Lower Saxony and labor is half your supervisory board to cut plants. So to some extent, I think this is a political move to something they've always wanted to do. But you're absolutely right. I mean, we don't need as many cars potentially as what we did in the past, what they thought they would need to produce. And this EV slowdown is in full effect. VW has been pushing very aggressively towards an EV future, full electric. And in Europe, if you look at the data, it's been shifting aggressively to hybrid. Just look at the Toyota numbers. They sell a ton of hybrids there. So I think part of it is let's pivot, maybe not as aggressively to BEVs, which require a dedicated plant. Maybe now they could produce more ICEs and hybrids on existing facilities. You don't need as much. But so part of it is the EV slowdown. Part of it is also kind of political gamesmanship. Something they've always wanted to do is to reduce the plant footprint.
Well, let's talk about the games politically now. Ultimately, they're crying out for more subsidies, aren't they? Doesn't the state have to subsidize the hell out of this in Europe? Do they have the appetite to do that?
That's been the issue, right? I mean, at the end of last year, Germany cut these subsidies, and you're seeing the result of it in the EV sales kind of fall off a cliff so far this year. So, yeah, in Europe, it's the EV demand is all about subsidies, right? And they have these huge CO2 rules they have to comply with. We don't have that issue in the U.S., and yeah, they're going to have to step in. The problem is, can these governments really support these subsidies? That's an open question, and until they do so, people are going to keep buying hybrids.
This is a Lisa question. Will the market fund it? I see this issue in Europe now as a major one for financial markets potentially. Ultimately, you've got these automakers saying, we've got overcapacity, we're cutting the factories. They want to hold on to the factories because they're worried about the politics, and particularly the shift to the right in places like Germany. So ultimately, this is the dilemma they face. Either they allow the factories to close and people lose their jobs and the politics goes further to the right away from the incumbent, or they have to come up with the money and subsidize the hell out of this industry. Now, whether they've got the appetite to do so or the ability to do so, even if they have the willingness, is another matter altogether.
Which really brings 2009 back into the fore in the U.S., when the U.S. basically rescued the entire Detroit complex. And the question of what efficiencies or inefficiencies really emerged from that. Tom, from that experience, what will this look like in 5 years? What kind of legacy European program will there be? Because I can't imagine the government will let this fail, even if it is significant subsidies that are required.
I think you're absolutely right. I mean, two things could happen. Either they loosen some of these rules. For example, the ban on ICEs originally was 2030, 2035.
Mental.
That's probably going to be loosened, right? But the flip side is, you guys know Europe. It's they go down a course. It's happening, and that's kind of what we're learning when we talk to folks there, and who understand the political sphere. Is this is happening? Green parties, et cetera, have a lot of power there. They're going to try to go towards CO2 compliance. And that means the governments will have to step in eventually, or the hope that these automakers have is in maybe not today, but in 5 years, battery prices could come down. Unless it's kind of a chicken and egg thing, right? Like right now, EVs are expensive to make because there's not enough made, so there's no scale economics. But when you make a bunch of them, the price comes down. But if nobody wants them, then you can't make them. So it's this weird dynamic. You're going to need the government to step in to catalyze this, to lower the pricing. I have to believe that eventually is what happens. Maybe we're just in a lull phase right now, and the demand comes back in a few years. But that's really what it comes down to.
If I were a pessimist, I might say I was actually in several places in Europe, and I was really struck by how many Chinese cars were on the road. And it was very different than what I see in the United States. I was really struck by that. At a certain point, as you get sort of the discussion among officials in Germany and elsewhere and debates around how much they can subsidize, someone is knocking on their door and bringing vehicles in, and that's China. How much does that change the equation and permanently steal market share in a way that's irrevocable?
I think that's the bigger issue. That's the bigger threat. And it's not really a threat today. You probably, I don't know if you were in Norway, maybe you saw a bunch of them there. But actually,
no, but you can take me.
In Germany, you actually don't have a ton of Chinese EVs. I think it's something that you hear a lot about in the press. It's because there's tariffs now, right? Europeans have put on them. But certainly, once the Chinese start producing those cars locally, it's going to be a threat. There's no way around it. And at that time, which is in a few years, the European automakers have to get their act together. They're going to have to lower prices, produce batteries domestically, and it's tough to do. They don't have the IRA like we do because they have to sell cars in China and they don't want to upset them, right? So I do think that's a big threat. But I would look, if I'm an optimist, I would look back historically at Europe. I was there for 4 years. You don't see a lot of Japanese cars. You see a lot of Fiats in Italy. You see a lot of Volkswagens in Germany, et cetera. Why is that? Or Peugeots in France. They like their national champions, and I do think the European consumer at the end of the day will buy the car of their country. But to your point, maybe something is different here. we have to wait and see. I do think that's a bigger threat in the next few years. Ultimately, the governments will step in and try to protect, because it comes to do with jobs. That's where Europeans care about more than anything else.
Yeah, absolutely. And already you see news that the union is saying, at least with VW, potentially will accept a 4-week work week in order to maintain people keeping their jobs. You mentioned the IRA, so quickly, what parts of the IRA stay or go if we get Trump?
I think it's really difficult to undo the IRA. And remember, a lot of these battery production facilities are in purple or red states. So that means jobs. It's something that I don't think Trump wants to do anything to destroy. But I do think that ultimately they could take away like some loopholes. Like there's this lease loophole. If you lease an EV, you get the subsidy. I'm not quite sure what's the justification behind that. That could potentially go away. There could be some limitations on when you can get the $7,500 credit. You know, if you get a lot of sourcing from China or some amount, they could try to attack that again. But that happens from both administrations.
Yeah.
But ultimately, battery production domestically in the U.S. is something both administrations would, I think, support. So I think it's here to stay.
Just before you go, plenty of problems. Some companies are doing okay. I can think of one in Europe, BMW, better numbers on the EV side. You mentioned Toyota, just in the right place at the right time, right strategy. Stuck with hybrids, didn't go all the way to EVs. Who's doing it right stateside? Which company do you like right now?
Yeah, and I think this comes down to what you guys are talking about earlier with soft landing and rates and all that. Like, if we do get into a soft landing, this industry actually is very interesting, very attractive, because they built up so much cash during the pandemic, and now some of these guys are buying back a ton of stock. So notably GM. And if we do get into a soft landing, I do like that name. But outside of that, if you want it to be defensive and you're worried about autos, then I think a name like Ferrari, even though it's very expensive, potentially, it's a place to hide out. And then, I know this sounds really weird, in a weird way, Tesla is defensive because it's not really autos, and they could just at any day pull a lever and lower FSD pricing, something that everybody should try. And I think that could be an interesting one.
Nice to squeeze some Ferrari in there too, Tom. We appreciate it. Tom Naran there of RBC. Welcome back anytime. That was great, Bramo.
He was pandering. He's completely pandering. I'm sorry. Did he pay you off?
Not
like
at
your
all.
national champion? Okay, it's beautiful.
Not at all.
Okay, you own a Ferrari?
No, I wish I did.
I know, who doesn't, right? It's your national champion.
It's everyone's national champion.
Oh,
Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. People familiar with the matter telling Bloomberg that police in China have detained 5 current and former employees of the British drug maker AstraZeneca. They are all Chinese citizens being questioned over potential illegal activities. One probe related to the company's collection of patient data. Authorities also looking at the importing of a liver cancer drug that hasn't been approved in the country. AstraZeneca told us that they are aware of the situation, but have no further information. Verizon says it will buy Frontier Communications for $38.50 per share. It's a $20 billion deal, a 37% premium from Tuesday's close. Frontier bills itself as the largest pure-play fiber internet company in the U.S., so the combo would help Verizon offer high-speed internet more widely. Demand for data usage is only expected to grow, forcing telecom providers to bulk up their offerings. And the 2024 NFL season is upon us. The defending champion Kansas City Chiefs host the Baltimore Ravens in the season premiere tonight. The league then makes its Brazil debut tomorrow, where the Packers and Eagles face off in Sao Paulo. Betting on games this year is predicted to take another leap forward. $35 billion in wagers is expected to be made this season. That's your brief, John.
Hey, Danny, thank you. More from Danny in 30 minutes' time. Up next on the program, payrolls just around the corner.
If we see a number closer to 100,000 this month, then we'll have to reassess our sort of view on the labor market. But our base case is the print should come in pretty solid.
What if it comes in pretty solid? We'll talk about that next. From New York, this is Bloomberg.
The names that move markets are on Bloomberg.
Our role in the world, our role in NATO in supporting the Ukrainians in this war, the unprovoked war that Russia has instigated in Ukraine, our support for the Indo-Pacific, for providing a counterbalance to China. All of that is in our interest. And whoever's president, I'm sure, is going to do what's in the best interest of the United States.
It is not a time for America to back off of its commitment around the globe. And I think there's a justification for us making certain that we do the right things in a way that we share the burdens with our allies. But I don't expect America to walk away from the world in any administration. It's about American security, and it's about making certain our adversaries, present and future, know that when America's committed to something, they're there for the long haul.
Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
DOJ or other authorities
Could face bigger challenges. What's next?
It was going to keep bringing the World Cup. This is a three as the economic picture, covering the intersections of Hollywood, Silicon Valley, and beyond.
Stocks unchanged this morning. Good morning to you. Going nowhere on the S&P 500, which is maybe good news if you've been long this market over the last few days. In the bond market, yields higher by a single basis point off the back of a big rally to start the month of September. The 10-year 376.84. Under surveillance this morning, payrolls just around the corner.
Our base case is that a lot of the softness that we saw in the month of July was driven by Hurricane Beryl. And we'll see a 37,000 rebound from the state of Texas, in which case our payroll print will be above 150,000, which we kind of view as trend. So if we see a number closer to 100,000 this month, then we'll have to reassess our sort of view on the labor market. But our base case is the print should come in pretty solid.
It's the latest. Traders looking ahead to labour market data for evidence the Fed has achieved a soft landing. ADP employment coming out at 8:15, followed by jobless claims at 8:30, all ahead of the highly anticipated August payrolls report tomorrow. Kathy Bosjancic with Nationwide Mutual Insurance making this call. We anticipate the economy created a solid 160,000 net new jobs in August, following the softer than expected 114 back in July. This moderate rebound reflects a resilient labour market despite broader economic uncertainties. Kathy joins us now for more. Kathy, you draw a distinction between normalizing and deterioration. Is that a distinction without a difference, given the guidance we've had from the Fed chair in the last few weeks?
Well, good morning, John. No, I think that's exactly what he's talking about. You know, the Fed all along has been aiming to slow down the overall economy and cool the overheating labor market. So if we do get the consensus-like forecast, and we're right there with the consensus, if we get that solid increase, then I think they feel confident that they could, you know, they're on the way of achieving the result of a soft landing. And, you know, there's that normalization. You look at the JOLTS data, the job opening to unemployed workers is now closer to 1, right? In the middle of 2022, it was 2. That was 2 jobs for every person unemployed. That was an overheated condition. However, as you know, careful what you wish for, because it's the pace of the deceleration and things could get away from the Fed. And we could see a slower or harder landing in the labor market than desired.
Kathy, when you look at the underlying growth mix in GDP, when you look at the lack of cyclicality in hiring in the jobs report, where does your confidence come from that we stabilize at these levels?
Yeah, so, and our confidence is really just for, I would say, for this quarter. As we look ahead, we do think that we see employment growth slow below trend, and we're actually looking for GDP growth to slow below 1%. That's a soft landing. But what you're seeing is those acyclical sectors like healthcare, even leisure and hospitality, they remain sturdy. Even education, government, they continue to add jobs even when the more cyclical portions of the economy are struggling. But no doubt, there's an issue, right? The labor market is cooling, and I think the Federal Reserve needs to come to the rescue of the economy, remove the restrictiveness in policy, and then that, I think, helps stabilize things. That's the call for the soft landing, but there are great risks around that call.
Kathy, what's the downside to going 50 basis points at a time where there's enough signs that this is a restrictive and maybe even very restrictive Fed policy that's potentially going to accelerate any kind of weakness?
I personally would prefer they did start a bit quicker and go 50 basis points, but I think the risk is that the markets will extrapolate even more aggressive Fed tightening, and they're already, pricing in, over 100 basis points of rate cuts for this year, and then 200 basis points over the next for the full year, and by the end of the year, 100 basis points. So I think that's what the Fed is a little tentative about. They don't want the market to go ahead and race further ahead of them. Plus, I think there's some still uncertainty about the inflation. They're still probably feeling the sting of the Q1 numbers, but I think if you look at the inflation data, especially the 3-month annualized rate, there is clear reason for them to actually go a bit bigger.
If the 50 basis point cut, if they were considering that, but they're concerned that that signals really bad news is bad news, and this is a serious deterioration in the economy, what number would we need to see on Friday that could push the Fed, though, to that 50 basis point cut?